Very good morning, everyone. This is Bhanumati. Yes, very good morning. This is Bhanumati going to handle you the subject merchant banking and financial services. Are you there? Can you hear me? Shall I proceed? Anybody there? Okay. Okay. Shall I proceed now? We have 2 hours today. This 10 to 11 and from 12 to 1. We have 2 hours. And for MCom, for each subject, you will be allotted for 5 hours only. And for each subject, you will be having the 5 units. So for 1 hour, we should complete 1 unit. So by this hour, we shall start this first unit. We'll complete this unit, and by the next hour, by 12 o'clock, we'll be doing with the unit 2. Okay, so we'll see the first unit now. So we are going to see about the subject merchant banking and financial services. Let me share the PPT for you. Yes. Now, in the subject merchant banking and financial services, we are going to see the first unit that talks about the financial service industries. Now, the first unit, the syllabus of the first unit talks about this financial service industry. We are going to see about what the financial service industry and main important concept we are going to see in this unit is about fund based and non fund based activities. That is very important. Only two and or three topics covered here, mainly the fund based and non fund based activity, and the other one is the modern activity, or you may call that as a new financial product or services, and the innovative financial instrument, and what are the challenges or what are the problems which is being faced by the different instrument. So the topic, the content which is given in the syllabus, which is listed down below. So these are the topic we are going to see now. Now let me say about what is the financial system. After knowing about the financial system, we'll see what is financial services. In financial services, we are going to see about the meaning, its nature, and then its function. And we'll see about the various financial services which is being availed or which is being used by us. This various financial services may be termed as the fund-based and non-fund-based activities. The financial services is classified into two. We'll see about the fund-based and non-fund-based activity in the third topic. We'll see about various new financial instrument, and finally we'll see about the challenges of financial services sector particularly. So we are covering all the three major topics in the first unit. One is fund based and non fund based, other one is new financial instrument, and the third one is the challenges of financial service. Only these three topics are dealt in the first unit. We'll see one by one. Now, before knowing about the financial services or about the subject, let me talk about what the financial system is. Financial system is where it is calcified into four different categories, as that is shown here. One category is financial market, other category is financial instrument, other one is financial institution, and the last one is financial services. Now, financial market, the first one, financial market means it deals with the market. It may be the money market or the capital market. That is the financial market. In financial market, various financial instrument are dealt with. So financial market where we go and trade, we use all sort of instrument. That is the second part. Without the financial instrument, we cannot trade in the financial market. The financial instrument or plenty of instrument are there. Simply to say, check, commercial paper, bill of exchange, promissory note, or some other the instrument, bond, debenture, etc. All these are the financial instrument, and that is being used and traded in the financial market. And these instrument, while traded in the market, we need to have a certain help from various institution, various agency, various intermediaries. We may call them as a financial institution. Financial institution means we may call as a merchant bankers, venture capitalist, or you may call it as the insurance company. Various financial institution may help you to trade in the financial market with the help of financial instrument by taking the financial instrument. Now, what are the financial services? Services which is being provided by the financial institution. The financial institution provide n number of services. They provide financial venture capital. They provide insurance facility. They provide leasing facility. All these are the services which is being provided by the financial institution to trade in the financial market. So these are the different categories or different concept. So everything is being used or being dealt in the financial system. So financial system is the involvement of the financial institution and making use of the financial instrument and trading in the financial market. These four cannot be separated. They will be dealt together. So this is the concept called financial system. So in this financial system, we are going to see about the fourth category, financial services. That is your subject, merchant banking and financial services. What are the financial services that is being provided by the financial institution? This is your subject. Next one. Now we will see about what is the financial services. Financial services means the financial assistance or financial help that is being provided by the financial institution or financial intermediaries. Financial intermediaries, maybe I can say even the merchant banker, venture capitalist, normally the commercial bank or insurance company. These are various financial institution or intermediaries. They will be helping the general people for entering into the financial market. So these are the various services is being provided by the financial intermediaries. So the service may be called as why we are one, that service is being provided in order to mobilize and in order to have a certain sort of savings in the minds of the public or general people. So that is called financial services. Now, we call this services as the financial service industry. What is that industry? So, industry level, if we speak, the financial service industry may be called as, it is a collection of organization. It is not one industry, or sorry, one financial institution. It is a collection of institution which they facilitate all those financial transaction for the individual or for the institutional investor. So whoever it might be, this financial service organization will be helping the individual investor to enter into the market and trade accordingly. So it is together called as financial service industry. In financial service industry, they are classified into two. One is money market intermediaries and capital market intermediaries. This is all about the financial service and financial service industry. And we'll see about the nature of financial services. What is the nature or what is the characteristics of the financial services file that is being uh, provided? Here, there is the person called service provider and the service seeker. So the service provider will be providing the service to the people and they gain out of it. So it may called as it is the one of the feature or not one of the nature we may called as the intangibility. The service or being called as intangible, we cannot see or touch, but we can make use of it. We can avail benefit out of it. They are supplying various services and giving the confidence in the minds of the customer and making them to have this saving habit. So it is called as intangibility. Inseparability means the second one. Inseparability is about the production and the supply of financial service has to be dealt continuously. So it cannot be separated, production separately or the supply separately. So if there is a financial instrument, if that is being started, then it should be used by people and that can be done only by the financial service provider. Then, perishability. The service that is to be created or delivered to the customer that should be as per the requirement, and we cannot keep and save those instruments for future period. So, whatever the instrument, whatever the financial instruments are being availed to the public, it should be used as a time when there is a scope for it, so it cannot be stored and kept as such. So if in this current scenario, if certain financial instrument is popular, then people opt for it. We cannot go back to the past and use the older financial instrument. So we have to, or the customer has to update them accordingly. Then dynamics. Dynamics means it is a flexibility to change according to the changes that is happening in the economy. The financial service provider or the financial instrument that is being used should be flexible. But it should be changed according to the condition, according to the trend, or according to the economic level or economic situation. People are going and investing in the gold, and everybody will be going and investing in the gold. If certain crisis happens and it is not being dealt by the people for recent time, they won't go for it. So there should be some dynamics, or there should be some flexibility over the change in the economy. If economy changes, automatically the service being opted by the public will also get changed. Then information based. So financial service industry, it is based upon the information that is being given by them. So it talks about the use of information, or information is a main component for providing those services. If the information is better and it is matching with the current trend, then the people may naturally use those financial services. So these are the nature, we can say that it is intangible, we cannot see or we cannot touch, but we can make use of it, or it is inseparable, we cannot separate the production and the supply. Perishable, we cannot keep the financial instrument as a stored one. The service cannot be stored. Dynamics is it is the flexibility, like accepting all the changes. And information based is that is receiving the past historical data and acting according to it. Now the functions. What are the various functions or the service which is being provided, the activity being done by the financial service provider? So the main function is they help the firm or the corporate industry not only to raise the fund but also for efficient deployment of funds. So they help. So the services being provided by in order to mobilize the fund, and they help the corporate. Another function is they helps to construct a better capital structure. Better capital structure means for the company, they may like have the category like about the debenture, about the equity capital, or about the preference capital that need to be allocated accordingly. So that is called as capital structure, the proportion of the debenture, debt, preference, retained earnings. That proportion can be fixed with the help of this financial services, and they also do factoring and forfeiting services. We'll see this concept about factoring and forfeiting in the upcoming slide. I will explain that. And that is being provided, that function is being provided, and not only that function, it also provide other functions like bill discounting, other services like e-commerce, securitization of debts, and other services like the venture capital, credit rating, lease financing. Everything will be seen in the topic called fund based and non fund based, the services. That is, we will see all these topics in the upcoming slide. So these are the functions, or these are the facilities that is being provided by the financial service provider. So we saw about what is financial system, and we saw about financial services. We talks about financial services, what it is, what the nature, and what the function is. The first topic content is over. Next, we are moving to the second content, that is the various financial services. That is the various financial services is classified into two. One is fund based services, other one is non fund based services. This is the one question which is very very important in this first unit, fund based and non fund based services. We'll see one by one. So these are the things which we saw as a function that is being provided by the financial services. We saw all these headings like I said, no, the factoring, forfeiting, leasing, venture capital, everything is a major function that is provided by the financial service. Now we'll see one by one what that is and what is its features. First, we'll see the fund based. In fund based, we have totally six. We'll see one by one. Leasing. Now, leasing is a contract between the owner of the asset and the beneficiary. There is two person called the owner. The owner is called as the lessor, and the beneficiary may be called as a leasing. Okay, so there are two such persons. What happens now? The owner, this leaser, he will give the asset. So leasing is talks about the asset that is being given on lease basis. So it is an agreement under which the firm or any other the person, either the firm or the single investor or single person, who or might be, the owner gives the asset to the other person called as a leasing, and that is given on the term called on the hire or for rent or for on the leasing process. So that is given to the other person on the lease rental. So the rent should be paid by the leasing on the frequent period, and the person who acquires the right is called leasing, and he may not get the ownership here. He may get the asset, and he will be using the lease, will be using the asset for which he needs to pay the rent for the owner. Here, the ownership is not being transferred. If your period of using it, the purpose of using that asset is got over, you can return back the asset to the owner. This is the concept called leasing, and there are various service provider, that is various intermediaries. There are n number of leasing companies. There are various leasing companies are there. So the these now they are called as a fund based service provider. So it can be individual or it can be the firm. So the person here I've given as a person or the company. There are n number of leasing companies. The company, they give right to use their asset and they receive rent out of it. So this is the concept of leasing. Now you have different types of leasing that is being given in your book also. The four different types which is given in your book, page number 15. You have different types. One is the financial lease, operating lease, and sales and lease back, and the other one is cross border lease. Now, what is operating lease? The major difference between the operating and the financial lease is, in operating lease, the ownership is not transferred, but in financial lease, the ownership, the asset will be transferred to the leasing along with the ownership. Yes, that is the major difference. So the leasing, the other things are same. The leasing utilize the property for certain period for which he has to give the rent to the owner. So these are the different types. So operating lease means you'll be using, whereas the ownership is not transferred. In financial lease, the asset is being get transferred to the leasing along with the ownership of the asset till the time of the expiry of agreement. So you'll be having certain agreement like for 2 years or 6 years or 5 years. So before the expiry, you have to return back. This is two types. The other two types of leasing. This one is the sale and lease back. The other one is cross border lease. Sale and lease back is very simple topic. Like the owner will be selling his asset to the leasing company. So you are having the asset, but you don't want to have it. What happens because having the asset is it gives a certain sort of expenditures. If that is not being maintained by you, now what happens? You are selling those assets to the leasing company. Okay, so your asset, a very big machinery, it costs 10 lakhs. You are selling that machinery to the leasing company. So the X or Y leasing company, they bought the your asset. Okay, so airline company, see the example, the airline company, they face many problems. So they are facing the problems, and so they sold their asset. They sold their plane to the leasing company. Now what happens? But they want to use that asset on lease basis. So they will be selling the asset to the leasing company and get back that asset on lease basis. So they will be providing only the rental basis. So rather than having the asset in their own hand, they are selling it and getting back the same asset, their own asset on lease basis. This is called sale and lease back. First, you are selling to the leasing company and getting the same asset from the leasing company and paying rent out of it. So your cost is very much minimum, like rather than maintaining a very big machinery, you're getting that asset and using on lease basis and providing rent to the leasing company. Now you as the owner become the leasing. Okay. The other one, the other type of leasing is cross-border lease. Cross-border simply the term called you are doing this leasing activity or providing the service across the nation or among across the different countries. That's it. You are selling your asset from India, giving the asset or entering into the leasing agreement with the other leasing company which is here in the other country or in America or whatever. So the same thing, the concept is it is called as a cross-border lease. Next one, the other fund-based topic content is the mutual fund. Mutual fund is simply like collecting the funds or investing in an instrument or investing in or making certain investment by n number of investors. So there may be n number of investors who join together, they collect the funds and they will invest in mutual fund company. Rather than investing in equity shares, you can invest in mutual fund because mutual fund is less risk. So that helps the investor. They seek major like they concentrate only on earning certain return out of it. So collection of funds and investing in the mutual fund company. It can be of gold or it can be of any other instrument. It can be of shares. It can be of bond. But mutual fund simply denotes the risk level is very minimum. So this is there are n number of mutual fund companies. So first we saw leasing, and there are n number of leasing companies. Second one is mutual fund. You have different mutual fund companies. You can invest your money in certain mutual fund companies. Then the third concept of fund-based instrument or fund-based intermediaries or the venture capital. Venture capital, as I said, the mutual fund is less risk investment. Venture capital means the capital or the amount for the financial assistance that is being provided for the young companies or for the new company or for growing company if they have the project so innovatively. If you have an innovative project that is not being done or not being uh, promoted by other companies, if you are having a very good new project and if you need fund for it, rather than going for bank or other different sources, you can go for the venture capital companies or venture capitalist. If you go and say about your project, if that is new and innovative and that is beneficial to the society, and there is a certain uh, venture capital company, they'll be providing fund for you. So that is the main motive or main feature of venture capital. That refers to the capital that is available for financing of new business venture, new innovative for the growing company. The fund is being provided. See the diagram also. There is a person called Sam. He has a very good idea, stating that idea to the bank and obtaining for loan that is being rejected. But if you go for the venture capitalist that is being provided by a girl or a company called Sue, the Sue likes the Sam's idea, and she is giving a fund to the Sam. What happens? The Sam will also get benefited, and the company which is being provided this financial assistance will also be get benefited. So this is the concept of venture capital. Next one is factoring. Factoring is there will be 3% dealt here. What is factoring means? It's an agreement between 3%. There will be a buyer, there will be a seller, and there will be a bank. There is a bank. These are the three different persons: buyer, seller, and the bank. Now, what happens? The buyer they purchase certain number of goods or some assets or whatever it is. They bought something and they need to pay a certain amount to the seller. The seller who is in need of the money, what happens? Here the seller sells the invoice to the bank. If the buyer is need to give 5 lakh amount, okay, that should be given by the buyer to the seller. But the seller is in need of money in urgent. He wants that 5 lakhs immediately. What happens is now the seller will give the 5 lakh worth of invoice, the bill, to the bank. To the bank he will be giving, and from the bank he collects the money. Okay, the seller will give the invoice to the bank and he collects the money. He'll get either 4 lakh or 4 lakh 50, whatever, or either the full amount. Okay, he'll be getting. Now, the banker's responsibility now starts, and he will be collecting those cash from the buyer because he has given the money to the seller and he settled the seller's account. Now, what happens? The bank will go and approach the buyer and he will be collecting the money on behalf of the seller. What is the benefit of the banker? The banker will get commission out of it. He'll be getting some commission, so he'll be doing this type of service which is being provided by the bank is called as a factoring. You understand? So now see, the factoring is an agreement under which the factor purchases the accounts receivable and makes immediate cash payment. Now, factor is a person called the banker. Banker is called as the factor. He'll be purchasing the invoice from the seller and he'll be paid immediate cash to the seller. So that is over one part. And after that, he'll be collecting the same money from the buyer. Factoring is done by the company who requires immediate money. This is one type of service that can be done by, and there are again you have a number of factoring companies and even banks will also take this facility and provide factoring facility. Now the other concept called as forfeiting. Forfeiting is somewhat similar to the factoring, but here what happens here, the forfeiting is a financial tool that is majorly helping the exporter in order to convert their credit into the cash. now here the exporter sells their trade receivable or the invoice. So the amount that is being it to be collected, the exporter sells those trade receivables or the invoice to the third party. So, like the previous one, here the exporter sells to the third party, we may call it as forfeiter. Like the previous one, the banker or the factor, here it is called as the forfeiter. So, he'll be selling and he'll be getting certain money from the forfeiter. Now the third party has to receive those payments from the importer. So this is done uh, as an international basis. The exporter is selling the all those trade receivables to third party. He will collect cash and he will go back. Now the third party called as a forfeiter will be collecting the same amount from the importer. This process is called as a forfeiting. See the diagram, it will be understood like 1, 2, 3. Uh, the step is given as the number basis. So the importer, the receivable sends the or availing guarantee, and the guarantee received returned to the importer after two. That is being sent to the exporter. Now, what happens? The forfeiter has to collect the amount from the importer. Now, the other one is the housing finance, the last fund-based finance provided by the financial service provider is the housing finance. Simply housing finance is certain financial assistance is being provided, either the home loan or whatever the amount you are in need, and that is used for the purpose of constructing the house or buying the house or whatever. There is separate service provider called the housing finance company or housing finance limited that is being provided. The housing finance, it is a collection of the financial arrangement which is offered under the head called housing finance company. So this was first introduced by the Housing Finance Bank, and that was introduced by RBI in the year 1988. Some of the institutions to mention I have given here: HDFC, LIC Housing Finance, City Home, Indian Bank, Bank Housing, etc. There are n number of housing facilities that is being provided by the various number of companies. So these are the fund-based service which is being provided. So we saw around about the leasing, mutual fund, venture capital, factoring, forfeiting, and housing finance. Now we'll see about the non-fund-based financial services. Under that, we'll see about the merchant banking. What is merchant banking? It is an institution that covers very different varieties of activities that is provided. It can be of underwriting, it can be of portfolio management, or project counseling, or insurance, or various service being provided by the merchant uh, banking. So for all, they render the services on certain fee that is charged. Suppose the commercial and the investment bank also, they will do merchant banking activities. Bank, they provide merchant banking facility. There are merchant banker also separately. So the service which can be uh, provided, either it can be of banking services or it can be of consultancy services. The main purpose of the merchant bank was to facilitate or provide the financial promotions in the name called merchant. Okay, so that is called the merchant banking. And the other one is called as the credit rating. Credit rating means it talks about the worthiness or the willingness of the issuer to provide or to fulfill the financial obligation. So the credit rating means if you are a company and if you're buying certain properties or assets or whatever commodities, whatever it is, your company is to be rated by the credit rating agency. Whether your credit score is poor or average or good, it says about your worthiness to repay the amount. That is called the credit rating. So, are judging the credit worthiness of the borrower or the company. So, if you are borrowing certain things from the company, that company's credit worthiness uh, should be analyzed. So if it is very poor, that company will not repay you the money. If company's credit rating is average, okay, we can believe. If that is very good, naturally you can enter into contract with the company. So your credit score should be analyzed and it should be rated. And this rating is done by the credit rating agency. There are a number of agency and they will be rating. There are different symbols that is being denoted. If you say about A, it is highly secured. There are certain terms B, C. So there are certain terms. So your company or every company should be being judged by the credit rating agency. This is also a service which is being provided by the credit rating agency. That is, they are judging about the credit worthiness of the company. So this is a service. Okay. Next one is the other service which is being provided is the stock broking services. So the brokers, they have certain agency, they have a certain group like stock broking agency. They will be providing services, or they will be guiding the investors or guiding the people to enter into the market, and they will be telling them like how to trade in the financial markets. That is called the brokers. They'll have a stock broking agency separately. Then the next topic is about loan syndication. Loan syndication is a simple topic, like if you want a certain amount as a loan, if you approach the bank, they may say like this is a very huge amount, I cannot give you, like this is if the amount is so big, and if one bank or one institution is not ready to pay, now what happens, that the amount is being provided by different or n number of institutions. See here, there are co-lenders. N number of co-lenders, they will provide financial assistance under a head called admin agent called a bank. If A is a bank, they need to provide a 10 crores. If 10 crores is the very big amount, then A bank will ask about B, C, D, and all other different banks. They join together, they collect that 10 crores, and they provide that amount to the borrower. Okay, so the borrowers have a touch with only the A bank, but the A bank is collecting the amount from other different banks, and they are providing that huge amount to the borrower. So it is a very big the facility which is being used by the bank. Okay, so our head, the borrower's head is only dealing with the admin bank and not with the other co-lenders. Okay, that is called loan syndication. No. So that's it. The first, second topic of non-fund based service is over. The non-fund based financial services, we saw about merchant banking, credit rating, stock broking, loans, syndication, and yes, we saw about loan syndication. So these are the four different non-fund based in the financial services that is being provided. So in your book, they have given about leasing and the merchant banking mutual fund separately. They didn't have the calcification, but if you write good, the calcification will be well and good, right? Now, this is all about the first content. Now, the second content in your book, it is given like 1.1 and 1.2. Now, 1.1 content is this one, and the 1.2 content is about the new or the innovative financial instrument. That is the three innovative financial instruments or new financial instruments: fund, the debt instrument, equity instrument, and the hedging instrument. This is very basic and very common. You can write if you know about the debt instrument, you can write not seeing your book, but you can write on your own words too. We'll see the first one, the debt instrument. Debt instrument is a form of it is a form from where you can collect the funds by issuing the debenture or the commercial paper or convertible bonds. There are many debt instruments are available. So you'll be issuing the debenture or bond, and for which you need to pay the interest out of it. And each and every instrument will have its own features. For example, commercial paper, it is being issued by the large company for shorter period. If you need money for within 1 year or within a period of 90 to 365 days, then you can go and issue the commercial paper so that you'll be getting the money in hand at a stretch like within a shorter period. Then you will go or you can use this commercial paper. So the amount raised will be high. So it can be issued by the big company or the larger companies. Convertible bonds is a type of security that can be easily converted into equity. So if you're issuing the debenture or a bond and people are buying, then at a certain period or certain stage, they can convert those bonds into the specified number of equity shares. That is another features. And there are n number of different debt instrument that is being given in your book. Carrot and stick bonds, convertible bonds with the premium for debt with the equity warrant, dual currency bonds. So these are the different types of bonds, and it has its own features. You can selectively, you can read like selecting 5 or 6 instruments. And you can learn about it. And the other one is the equity instrument. Uh, Equity instrument, like equity means it is the instrument that represents the ownership. Like if you buy the equity shares, you'll become the owner of the company. So like the debt instrument, you also have n number of equity instruments that is being provided. There are that is given in your book. You have capital market, you have financial market. If you want the equity shares for around before like 1 year, you can go and enter into the money market equity instrument. And if you opt for more than 1 year, you can go and buy your shares in the capital market. This is the second one. And the third one, the third innovative instrument or new instrument is hedging instrument. Now, hedging means reducing the risk. Okay, the term simply to understand is hedging means reducing the risk. Hedging instrument is where if you use those instruments, you can reduce your risk or you can limit your risk or whatever the asset, whatever the commodity you are buying, whatever shares you are buying, whatever forex or foreign exchange transaction you are doing. Hedging instrument means it is the way of reducing your risk. Okay, there are various hedging instruments that is dealt. I have stated here as forward contract, future contract, or money market instrument. So if I talk about the hedging, I can say like don't put all your eggs in one basket. If you're having a basket and having 10 to 20 eggs on it, if something felt wrong and if that is being broken, all the eggs will be spoiled. So hedging, which says like don't put all the eggs in one basket. Rather put 3 eggs in one basket, 10 eggs in another basket, and 5 eggs in another basket. If one basket is getting spoiled, only those assets or those shares will be gaining loss or whatever it is. So if you are spreading or diversifying the risk, that can be done using the hedging instrument. So hedging means reducing the risk or diversifying or spreading the risk. So accordingly, you can judge and invest based on this hedging instrument. That is the three main like new instrument, that is debt, equity, and financial hedging instrument. The final topic, the last topic which we are going to see is about the challenges. What are the challenges that is being faced by the financial service provider or financial service sector? The first one is lack of qualified personnel. Like to provide the services, you need to have the human support. That is not being availed. If the person is not available with that quality, with that skill, with that experience, then automatically you will fail in the market. Whichever the service provider, either merchant banking or factoring or bookkeeping, you need to have a skilled person, qualified person to provide that service. If that the professional experience based person is not here, then automatically you will fail in the market. That is lack of qualified personnel. So these are the challenges, these are the problem you will be facing. Though you are called as a financial provider, you are providing financial services, you need to have a human support for it. If that is not there, you will fail in the market. Second one, lack of investor awareness. Now, the first one, you have the qualified person, experienced person, skilled person, and if the investor is not aware about the service which is being provided, then what's the use of being there for you to provide such services? So one side you need to have the personal skilled person, professional person. Other side, the investor or the person should know or the individual should know about this type of services being provided by so called the provider. So investor should have the awareness. So you need to create those awareness. If there is no such awareness, then automatically you will fail in the market or it will become a problem for you. The lack of transparency. So you know, you need no, you should not have a secrecy in your accounts or in your system of maintaining the records. The disclosure of your transaction of your account should be transparent so that the investors are not aware, they can know about what is here that's being happening in the market or that what the service that is being provided by you. So the financial service provider, whatever service they are providing, that should be transparent. If there is lack of transparency, obviously that will be a challenges for you. Then lack of specialization. As like the skilled person, if you don't have specialized area in your field, so all type of financial services and dealings have different varieties of instruments. What type of specialty you have as a financial service provider? So that is called specialization. So here in one topic also you need to have specialization, right? So likewise, if the financial provider is providing the services, you need to have a specialized area that focused on providing certain services. What is your specialty? Lack of recent data. Now you need to have a data like past historical data, comparing past data with your present. You need to have a certain database to talk about the particular service to the general people so that they might have certain awareness to talk about the services compared with your past data. And the last one is if you don't have the efficient risk management system. If there is a lack of risk management system, you're not managing the risk that is being happening frequently. There are a number of risks, like you may have exchange rate risk, you may have interest risk, you may have economic, political risk, or whatever risk that is here, you need to balance it. So you need to have the efficient management system for managing those risks. If you don't have that, automatically you will fail in the market. So these are the challenges or these are the problems which is faced by the financial service provider. The financial service provider, I may say it is a merchant banker or leasing company or factoring company, whatever it is. They need to have these things. They need to have qualified person. They should the investor should be aware about you, the transaction should be transparent and you need to have the specialization and you need to have the recent data and risk management system. If everything is there, then you will survive in the market. If things are not there or if you fail in any of this, then that is your challenges or that is the problem you can face in the market. That's it. Yeah. The first unit is over. Like, let me take the first slide. See, like, saw the first unit. We talked about financial system, and we saw about the financial services, what it is. We saw, and we saw the nature and functions. And the third one is the important topic: various financial services. That is classified into two: fund-based and non-fund-based. We saw certain number of fund-based services and certain number of non-fund-based services. And we saw this one, the new financial instrument. We saw what is debt instrument, equity, and hedging instrument. And finally, we saw about the challenges of financial service provider or financial service sector. We saw about six the challenges of financial service sector. So with this, your first unit is over. Again will be a meeting at 12 o'clock. So the third hour from 12 to 1 we'll be having the same subject, merchant banking and financial services, my hour, and we'll be seeing the second unit. We'll go with the second unit by 12 o'clock. Is it okay?
Thank you, ma'am.
Okay, thank you very much. We'll see by 12 o'clock. Thank you, everyone.
Good morning. Let me start. If my voice is audible.
Yes, ma'am.
Okay, we'll continue with yesterday's class relating to international trade. So we are discussing about what is international trade, what is its importance, need, balance of trade, balance of payment. Then what are the various differences between balance of trade, balance of payment? That's the topic we have been discussing yesterday. So we'll continue with the next topic. What are the problems? I started with protectionism. That is, what are the problems you face and how it could be overcome. So we'll start with the discussion of today's classes. What are the barriers of international trade? So what are the different problems you will be facing when you are doing trade between two countries? So protectionism will explain what are the problems you might be facing and how to overcome those problems. So we have started with tariff quotas. I think you'll remember. So these are the reasons for government intervention for protecting and overcoming barriers, economic reasons and non-economic reasons. What are the economic reasons for overcoming the problem is preventing unemployment, protecting infant industries, promoting industrialization, improving comparative position. That is economic reason. Non-economic reasons is maintaining essential industries, dealing with unfriendly countries, maintaining control and preserving national identity. So these are the main two reasons why government interferes in providing safety for. So these are the two reasons why government interferes in uh, inside your foreign trade when you are facing so many problems. So economic reasons, one by one, we will discuss the reasons for government intervention. Economic reasons, so preventing unemployment. So, for by encouraging foreign trade, we want full employment and jobs has to be that is when you are having problems, it is going to limit your employment opportunities, limit your imports, and other countries may retail it. Impact on other industries also will be there. So, every industry's activities is related with the other. Second one is preventing infant industries. So, starting those who are in the initial stages, so even if they are liking to do foreign trade, some of the barriers will not make them to do. So efficiency in gaining take there is time to be taken, economies of scale that is within the given or availability of resources. You should try to earn more profit. So less investment, more productivity. Less investment, more profit. So if that is aim. Sometimes foreign trade will be protecting that, and government will be interfering in those things so that it gives protection. So promoting industrialization. Higher manufacturing base leads to higher per capita income. Then increase foreign direct investment, export-led development for local consumption, and nation building is building your infrastructure, rural development, skill development. So, being a developing country, we have to develop in all the areas. So that should be concentrated by the government. Then improving your comparative position. So you have to compare your balance of trade, gaining access to foreign market, restrictions as bargaining tool. The bargaining power will be limited when you go for foreign country, and if government interferes in that, sometimes that can be relaxed. So controlling prices, prices to be determined in the foreign country can also be helped by the government intervention. Then the next one is non-economic reasons. The reasons for government intervention for non-economic reason. One is maintaining essential industries. So it protects domestic industries, financial inclusion of necessities, rural penetration at affordable prices. The government should also concentrate on domestic trade also when you go for concentrating on foreign trade, supply of water, electricity, banking, railways, etc. So these are the various reasons why uh, you have to get the help for the government for maintaining essential industries. Then second point is dealing with unfriendly countries. So when you have dealings like from India to Pakistan, India to Afghanistan, or India to Sri Lanka, so when you have unfriendly situation between the countries, government intervention is very important. Why? Because they will protect you. So national defense, trade of strategic goods, data, encryption, the technology, arms and communications, banking, etc. So there should be restrictions for every organization. Are you all able to follow? Do you have any doubt in yesterday's topic relating to balance of trade and balance of payment? No doubts? Okay. We'll move on to the next one. Dealing with unfriendly countries, and third one is maintaining control. So government intervention is required. Why? Because they have to keep control for those organizations which is doing foreign trade. Why? Because they will not like to have the problems within the country. So maintaining control is also one problem, which is uh, governed by the government intervention. Then fourth one is preserving national identity. So national identity, every country has got their own identity, so they will not like to get disturbance relating to national culture, and the boundaries will not be relaxed for the purpose of trade. So all those things will be considered by the government on the topic of preserving national identity. And the next one, what are the various instruments of controlling trade? So one is tariff barrier and the other one is non-tariff barrier. Tariff barriers, three types of tariff you have. So tariffs will be on the prices, quotas will be on the quantity. That already we discussed in the yesterday's class. So what are the barriers we will be having in foreign trade? So what is tariff barrier? It is on the price of goods traded, also called as duty or tax levied on goods traded internationally. So most it is a most common type of controlling trade. So when you want to increase trade or decrease trade, you can use tariff barrier. So types of tariffs: import, export, and transit tariff. So import tariff collected by importing country, export tariff will be collected by exporting country, and transit tariff will be collected by the country through which the goods are passed. So once you are transiting your goods to any of the foreign country, like for example to US, and in between if it is transited through any other country as an intermediary, and that tariff will be called as transit tariff. So import tariff, export tariff, and transit tariff are the three types of tariffs used in tariff barriers. Then non-tariff barriers may directly affect either price. Do you have any doubt in this? What is tariff? Or you're listening? Srimati, tariff is clear.
Yes, ma'am.
Yes, ma'am.
Okay, transit tariff will be paid to those countries in between. We will be acting as an intermediary for your transit. Then non-tariff barrier may directly affect either price or quantity of goods traded internationally. So non-tariff, that is, it may be the other tariffs like subsidies, tied aid. So types of non-tariff barrier is like quotas, all those things will be considered as non-tariff barrier. So subsidies is direct assistance to companies making them more competitive. So some extra concessions will be given by the government. So non-tariff first one subsidies is direct assistance to companies making them to be more competitive with the foreign companies which is competing in the foreign country. Then the second one is tied aids. It is a loan to other countries, a part of which is spent in donor country. So you'll be helping the other countries also by giving a loan so that they'll be using it for telecommunication or infrastructure possibilities for making their trade successful. Then third one is minimum sale price. So that comes in a non-tariff barrier. It is goods sold at a price set by the authorities after clearance. So minimum sale prices, the price if it is very less, then more number of customers can be expected because of this minimum sale price. Then fourth one is quotas. So quotas is on the that is it is levied on the quantity. So it will be limiting when more and more quantities is imported to restrict your import. Quotas can be levied, or you can restrict in your own country the products to be exported if it is not available to the local people. So whatever you are exporting, it should be surplus that might be made available in a foreign country. So first it's for your country, next is for the foreign country. So in case if the government feels that the quantity available in the local market is not enough for the local people, then quotas might be used. Then the next one is embargoes, that is, it prohibits all form of trade from a country or a category of goods. So this will be restricting only the goods type. So, for example, if the product what it is needed for your any tablet or any ingredients what you require for the local market, if it is found to be exported more, then this kind of non-tariff restrictions can be levied. So that will be for restriction from a country or a category of goods. Then the sixth one is buy local. So favoring domestic producers or goods of local origin. So instead of making a product available from a foreign country, you will be asking your public to use your own domestic producers' products. So make your product available in the local market. Then the next one is specific permission. So some products under import or export given under proper licensing. So with proper license, if you are using your products to be sold in a foreign market, then there will not be any question asked by the local people or local government. Then the next one is we will move on to the next topic, that is exim policy of India. Okay, next we will discuss about exim policy of India. What is exim policy? What is exim?
Export import, ma'am.
Export import. Okay. So why we have to go for foreign trade instead of concentrating on domestic trade? What are the benefits you will have for foreign trade?
They contribute to economic development of our nation.
Yes. Economic development. Economic development, when you say it includes everything. And one more thing, if you have enough resources, it can be utilized for manufacturing more products so that you will be using the space available in the foreign market also. So next topic we will have for discussion is exim policy of India. What is exim policy? So export import policy, which was coming under foreign trade, and for every 5 years you'll have that is for annual policies were made, but from 1985 3 years policy was made, and finally we are going to discuss about the recent exim policy, which is in India. So exim policy. It contains policies in the foreign trade, that is with respect to import and export from the country, and more especially export promotion measures. Why export promotion is concentrated? We want more export, we don't want more import. Export means selling abroad, and import is bringing goods into India, any goods and services, if it has got relaxation. So, what are the various objectives of exim policy? So there is countries transition to a global. Every part of the world, everybody is going everywhere to do business, and the restrictions have been relaxed to avail maximum benefits by expanding their company as a global brand and making use of the opportunities available in the foreign countries also. So exim policy, it stimulates sustained economic growth. Technology can be developed and efficiently it can be used. Employment opportunities can be improved, and you can even improve your standard of manufacturing according to the standard expected in foreign countries, and it provides consumers with good quality products and services at reasonable prices. So all these things will be possible when you have enough product to be sold in a foreign market, and at the same time you should also keep in mind that you also have customer focus of foreign customers. So you should know which customer you are selling products to, which country. So the phases of exim policy started with phase one. So import restriction and import substitution, that was from 1950 to 70s, and later on in phase two, export promotion and import liberalization, that is 1970s to 1990s, and phase three is outward orientation as extension to foreign country from 1990 onwards. So recent foreign trade policy or exempt policy, that is a new trade policy for the year 1520 was announced, and it was replaced, and that is it was a recent thing. It has got so many changes. So what are the changes and why this policy is given? It is as per the direction of DGFT, that is Director General of Foreign Trade, relating to export and imports of India. So what are the highlights of 1520 trade policy? They want a significant participation in world trade, and Commerce Minister announced the two new schemes. One is for there is merchandise exports from India scheme, and the other one is service exports from India scheme. So these schemes have got very it was welcomed by all the manufacturers. So merchandise exports for India to promote specific services for specific markets. And second scheme will benefit all services exporters in India. Those who are also exporting services, they will be getting the benefit from the second scheme. So foreign trade policy would reduce export obligation by 25% and give boost to domestic manufacturing. So many incentives will be available for these two things for SEZ zones also, the special economic zones also. So for FTP benefits, both MEIS and SC. One is for merchandise goods exports, and second one is service exports. So other benefits what they derived is agriculture and village products to be supported, industrial products to be supported in major markets ranging from 2 to 3%. Then services will be supported with 3% and 5%. And the other, there is reduced export obligation is 75% for domestic procurement. Under economic, there is export promotion credit guarantee scheme. Then no need to repeatedly submit physical copies. So documents will not be asked again and again, and that will be relaxed in this. So this was the condition of balance of trade. So foreign trade as an engine of foreign, there is engine of growth. So engine of growth, SMEs, that is small and medium sized enterprises. So foreign trade is going to benefit these three things. One is for employment, second SME, and third one is GDP. So first point, SME sector will be getting benefit because of foreign trade. So SME is small and medium sized enterprises sector. So India maximum we have small and medium enterprises, and out of the industrial output, there is 50% comes from this, and out of that 44% will be considered for exporting. Because of globalization and liberalization, we have got so many relaxation, so we can go for exporting products manufactured by this sector. So because of foreign trade, new customers are being got from foreign countries for SMEs products. The second one is GDP growth. What is GDP?
Gross domestic product.
Gross domestic product is full form. What is gross domestic product? Any idea? So when you are making your foreign, that is foreign trade will help us to improve your GDP. So GDP growth. So it is given merchandise trade as a share of GDP is the sum of merchandise exports and imports divided by the value of GDP. What is GDP is gross domestic product. That is what is that is. It is a market value of all finished goods and services. It is a market value of all finished goods and services which is going to have within the country's border, within country for a specific period. It can be for a specific period for a year. So that is what called as gross domestic product. So gross domestic product is the value of market value of all goods and services. So that will be improved because of in giving importance to foreign trade. Then the third one is employment. So when the foreign trade improves or increases, job opportunities will be improving, and automatically when job is improving, your employment scarcity, that is unemployment problem will be solved in India. So when exports increases, the production also increases. When production increases, the employment increases. So we want more employees to do work. But adversely, when you are importing your goods, it is adverse. So when all goods are imported from foreign countries, your production will be stopped and your employment opportunities will be going down. So it has got an adverse effect. So foreign trade will also help us to have employment opportunities percentage might be increasing from one stage to the other stage. So this is what we have to know under export import policy of India. Then the next one we will move on to the next topic that is Unit 2 relating to trade financing, financing of trade or trade financing, foreign trade financing. So what kind of financing available in. For example, if you're doing business in India, what are the various finance available for Indian manufacturers? Any idea? Will you start a business only with your own investment? So, financing, that is international trade finance. So, trade financing shares a number of common characteristics with value chain activity. So, we want finance for manufacturing the product or for selling the product or for services to be given to the customers. So, we have to decide what kind of finance we are going to use for international trade. So, international trade financing. So, what are the elements of import export finance? So, every export sales transaction covers three basic elements. One is contract, prices, and documents. So, what are the various things we have to concentrate on? Export financing is the contract. What is a contract entered into the two countries? What kind of products or what kind of services going to be exchanged? At what price you are going to exchange? And what are the documents to be supported for foreign trade? So these are the three basic elements you should know before starting your international trade. That is elements of international, that is foreign traders, documents, contract, and the prices. What are the documents needed? What is the price at which you are going to enter into a contract? And what is the contract is about is contractual exchange between two countries. Then export, import, what are the various documentation we needed for export, import transaction? So these are the various things we need. Bill of lading. So bill of lading, commercial invoice, insurance documents, counselor invoices, and packing list. What is bill of lading? It is issued by the exporter by a common carrier transporting the merchandise. So bill of lading is for transport. It is issued by the exporter and to the organization which is helping you to transit. So commercial invoice and counselor invoices. Commercial invoice is issued again by the exporter and contains a precise description of the product. So commercial invoices, you will tell in the invoice that with what product you are exporting. So it will give the complete detail about the product exported in commercial invoice. Second one is the third one is insurance documents. So insurance document must specify the contract of sale and what is the period for which you are going to transit and what are the companies involved in this particular transaction should be clearly mentioned in insurance document. Fourth one is consular invoice. It is issued in the exporting country by the consulate of importing country. So it is invoice given by the importing country telling that these are the various goods that has been exported from so and so country. Then the fifth one is packing list. So packing list will contain the details about the containers through which the products is transited from one country to the other country. So when you are doing international trade, these are the various risks you will be involved in the transaction. So international trade risk, that is, it will be covering time and events. So price quote, that is risk related to the price, and the second one is export contract goods and services, that is goods which are shipped will be under risk. So documents are accepted, goods are rejected or received, and finally cash settlement of the transaction. So this is how the trade will be carried out. So timeline, it starts with quoting the price and finally it will be reaching the destination for receiving the cash. So starting with price quoted, export contract will be signed if the price is agreed between the two countries. And once it is agreed, your products will be shipped and documents will be accepted for shipment and goods will be received in the importing country. And when once it is received, the payment should reach your exporting country. So cash settlement of the transaction will be finally done once your goods is received. Then what are the documentation of foreign trade transactions? So these are the various documents you will be requiring. Key documents is letter of credit. Letter of credit is document which shows a credit permission given to the uh, country which is going to make the payment. Bill of lading is a document given for transiting the goods from one country to the other country, and the draft documents, which is a sample. After finalizing or after checking, final the document will be taken as a final copy. And what are the functions of each document is letter of credit, bill of lading, and draft risk. Letter of credit, risk of non-completion. So till this task is not completed, bill of lading is foreign exchange rate. That is, the exchange rate might be fluctuating. So the risk related to for bill of lading will be foreign exchange rate risk. And draft is financing foreign trade. So financing the foreign trade, sometimes it might be financed by any government organization. So as soon as the contract is entered, it should be implemented immediately. So these are the various documents and functions relating to each and every document is given on the other side. And what is letter of credit? So a letter of credit is a bank's conditional promise to pay issued by a bank at the request of an importer, in which the bank promises to pay the exporter upon presentation of documents like letter of credit. So it is a guarantee given by the importer's bank to the exporter's bank, and they give a guarantee that importer will definitely pay to the exporter once the goods has reached the destination. So that is what called as letter of credit. So L bar C is letter of credit. It is given by the importer's bank to the exporter, giving a guarantee that the payment will be paid without any delay. So, what are the other essentials of letter of credit? It is a promise. So, issuing bank must receive a fee for issuing letter of credit, will be paid by the importer, and bank's letter of credit must contain specific maturity date, and it will specify the amount also. So, all these things will be listed in letter of credit, so that it gives a guarantee that the transaction will be happening without any problem. And what are the types of letter of credit? So, letter of credit is classified into irrevocable, revocable, confirmed, and unconfirmed. Any doubts, or am I going fast? Do you understand what is letter of credit that happens in foreign trade? Okay, revocable and unrevocable, confirmed and unconfirmed letter of credit. Irrevocable letter of credit are not cancelable. Revocable can be cancelled at any time. Confirmed is it issued by bank, issued by one bank and confirmed by the other bank. If it is confirmed, it is confirmed. If it is not confirmed by the other bank, it is called as unconfirmed letter of credit. So what are the advantages of letter of credit? It reduces the risk of default. Why? Because two banks involved in that, and a confirmed letter of credit helps secure financing. So if it is confirmed, payment must reach the opposite party. Disadvantages is when you are involving letter of credit, fees will be charged. So when you are charging the fees, that should be paid by the concerned importer, that is concerned trader. So that is a disadvantage. It is not given just like that by the banker. A particular amount will be paid by the trader to the banker for giving a letter of credit. So the next one is what is a who are the parties who are involved in letter of credit. So you have issuing bank and receiving bank, and the other one is the country. So issuing bank, there is the relationship between the importer and the issuing bank is governed by the terms of the application given by the letter of credit. So it is between the issuing bank and the importer. And the next one is import exporter and the issuing bank. So three parties involved is exporter, importer, and the issuing bank. So the relationship between the exporter and the issuing bank is governed by the terms of letter of credit issued by the bank. So three parties involved is exporter, importer, and the issuing bank. And what is the relationship between the importer and the exporter? It is a guarantee given for the trade. So these two persons will confirm the trade is guaranteed. And the next document involved in foreign trade is bill of exchange. So bill of exchange is a written order by an exporter instructing an importer or its agent to pay a specified amount at a specified time. So same way As you create a bill of exchange for domestic trade, a bill of exchange can also be created for a foreign trade, asking the opposite party to pay the particular amount on a particular time. So party initiating the draft is the maker, that is a drawer or the originator, while the counterparty is a drawee. So whoever is writing will be called as a drawer, and the other person who is going on whose name it is going to be prepared will be called as a drawee. Then negotiable instruments involved in financing. So negotiable, any documents which can be transferable can be negotiable instrument. Anything which can be converted. So as such, they provide a convenient instrument for financing. So for financing, negotiable instrument is also very important. So what are the various types of drafts? So you have side draft and time draft. So side draft is payable on presentation to the drawee. So when it is presented, only it will be payable. Time draft is which allows a late payment. Only when the time comes, the payment can be made by the person who is holding a time draft. So types of draft. Next one is the banker's acceptance. So when a draft is accepted, it is when before it is accepted, it's only a paper. When it is accepted, it becomes a banker's acceptance. So when you're drawing a bill of lading for an amount of 1 lakh, it has to be signed by the opposite party. Once it is signed and accepted, then it will be called as a document. It is not a draft. And the next one is bill of lading. So bill of lading is issued to the exporter by a common carrier transporting the merchandise. So it serves the purpose of being a receipt. So bill of lading is issued to the exporter by a common carrier transporting. So when you are transporting your goods to any intermediary, during that time they have to prepare bill of lading. Then what are the characteristics of bill of lading? It can be a straight bill of lading or an order bill of lading. So straight bill of lading provides a carrier deliver the merchandise to the designated consignee only. So it goes straightly to the person who has ordered it. An order bill of lading will be directing the carrier to deliver the goods to the order of a designated party, usually the shipper. So it goes and reaches the shipment area. So that is order bill of lading. A bill of lading is usually made payable to the order of the exporter. Then what are the additional financing things you have to use in international trade? Discounting, factoring, and forfeiting. So what is discounting is converting a trade draft into cash. So when you're discounting, it will not make you to receive the full amount. A percentage of amount will be discounted. If it is earlierly discounted, it will have to go for discounting draft or discounting a bill. Second one is factoring. So intermediary who will be helpful for selling your product. So selling export receivables at a discount to a factor. The factor will be intermediary who will be helping the trade to happen without any problems. So expensive but may be of great value to the occasional exporters. So sometimes you will not be able to sell or you will not be able to get the product, so you can get the help of factoring. Then the third one is forfeiting. Forfeiting is discounting at a fixed rate without recourse of medium-term export receivables denominated in fully convertible currencies. So it is a pre-planned or pre-fixed rate of discounting. So you will accept, I will be discounting 10,000 rupees if the trade transaction is 10 lakh rupees. So there is no possibilities of changing the terms and conditions if it is already fixed at a rate of discounting. So that is forfeiting. Then the next one is export credit insurance. So this export credit insurance provides credit, that is assurance to the exporter or the exporter's bank that the insurer will pay should the foreign customer default. So whenever there is a default, the insurer will be accepting the loss. So if you have export credit insurance, then it provides assurance to the exporter the money will reach you without any default. Then export import bank. So these banks facilitates all industries who's involving themselves for foreign trade. So these are the various things you have to know for special needs for financing in foreign trade or international trade. Next, we'll move on to the terms relating to international trade.
Ma'am,
Yes.
ma'am, many of the topics that you taught today are not in the textbook, ma'am. Where can we find notes? Can you provide us with the notes?
I will be providing at the end of the one unit. You can
Oh,
refer that.
yes, ma'am.
Yes. So we'll move on to the terms relating to international trade. So special needs are discussing about what is bill of lading, bill of uh, there is letter of credit, bill of exchange. All those things will be used for financing. So we want finance, and that finance can be provided by various institutions which is available for providing finance. So next. So terms relating to international trade. So Incoterm. What is Incoterm? It is international commercial terms which provides explanation of various terms to be used in international trade. That is called as Incoterms, international commerce terms. So what are the terms? Why it is important? It provides common, that is, you should have a common understanding of all the terms used in international trade. So what are the free on board? All those things will be carriage in freight. So it is very important to know what are the terms used in that. So these are the various terms we have to discuss under import terms. What are the rules for rules? First one is X works, that is XW, EXW. EXW is X works and is followed by a name place. What is X works? The X works means the seller's responsibility is to make the goods available at the seller's premises. X works. So it is not at the buyer's premises. X works is it is to be available at the exporter's place. The seller is not responsible for loading the goods on the vehicle provided by the buyer. Buyer has to make it. So sell it will be available only at the place of the seller. That is called as X works. Second one is free carrier. So free carrier is followed by FCA. It means the seller fulfills its obligation to deliver when it has handed over the goods cleared for export into the charge of the carrier. So for example, if it is the containers, it is free carrier means you should make it available to the container. So it is obligation of the seller to deliver it to the place of the container, that is called as free carrier. So carrier charges will not be paid by the buyer. Then CPT, it is carriage paid to. So CPT means the seller must pay the freight for the carriage of the goods to the named destination. So CPT, carriage paid to is by the seller. Seller must pay the carriage fees. Freight is carrying. So the seller must pay the carriage fees to the destination. He has to make charges incurred till it reaches the place of the buyer. Then CIP. So CIP is carriage and insurance paid. So CIP is followed by a name, that is example. It has got CPT also, that both it means. So the exporter arranges for export clearance and all export formalities. When it is, see, these are the terms that will be included in the contract. So if it is saying X works or CIP, it is understood that this will be backed by whom, exporter or the importer. So when this word, the term is included, carriage insurance paid, this will be made clear by the So exporter arranges for export clearance and he will be arranging and paying for all the costs for transportation. If it is CIP, carriage insurance paid. Then the next one is DAT. So DAT is delivered at terminal. This is replaced for sea transportation. Previously it was DES and DEQ and now it is delivered at terminal. With DAT, the seller bears the cost of the transport and risk until the goods are left unloaded at the terminal that the parties are agreed upon. So till the place it reaches to the buyer and it is unloaded from the ship to the godown of the buyer, everything will be bared by the seller. That is delivered at terminal. So all the costs will be borne by the exporter. And the next one is the delivered at place. So delivered at place means the seller delivers when the goods are placed at the disposal of the buyer on the arriving means of transport ready for unloading at the named place of the destination. So here the seller delivers when the goods are placed at the disposal of the buyer. So wherever the place the buyer wants a disposal, till that place the cost will be borne by the seller. Then DDP is delivered duty paid. So delivered duty paid is the seller has to pay the cost involved in shipping the goods as well as the cost and risk of carrying out the customs formality. So delivered duty paid, duty with the delivering charges, everything will be borne by the seller if it is DTP. Delivered duty uh, paid. Then next other terms is free on board, FOP, free on board. So what is free on board? The goods are placed on board the ship by the seller at a port of shipment named in the sale. So it is near to the seller's place, but the cost will be borne by the seller till it is placed inside the boat. For example, inside the container of the ship what the buyer wants. So till that place, the cost will be borne by the seller. That is called free on board. Free on board is till it reaches the board of the uh, transportation mode of which the buyer requires. So that is called as free on board. The next one is cost and freight, CFR. So cost and freight requires the seller to pay the cost and freight necessary to bring the goods to the named destination. So to the destination, whichever place the buyer wants the seller to distribute. Seller must take all the goods and take it available at the place of the buyer where he wants to get the product. Sometimes the buyer will come to your place, sometimes the seller will go to the buyer's place. So cost and freight will be the cost which is paid by the seller along with the freight till it reaches the destination named by the buyer. Then the next one is CIF. So CIF is cost insurance and freight. So cost insurance and freight, it is exactly the same for cost freight. It is except that the seller must in addition procure and pay for the buyer's insurance. So cost and freight, cost insurance and freight. Additionally, we have to incur insurance charges along with the freight. Then the next one is free alongside ship. FAS, free alongside ship. So this means the seller is responsible for the cost of transporting and delivering goods alongside a vessel in a port in his country. So free alongside ship is wherever there is in whichever shipment the buyer wants, till that place you can make your product reach. So this means that the buyer has to bear all the cost. So till it reaches a vessel, it will be responsible for the seller. After it reaches it, it will be the responsibility of the buyer. FAS. So these are the various terms we have to consider under INCO terms, that is international commercial terms relating to international trade. Any doubt in this? Shall we move on to the next topic? The next topic after international commercial terms. Next, we will move on to some payment terms we will be using in international trade. So, payment terms will be these four terms we will use in foreign trade: cash in advance, documents against payment, DA is documents against payment short form, open account, and letter of credit. So, what are these documents? There is terms relating to payment. So, cash in advance. We all know what is cash in advance. So, receive cash from the buyer before shipping. So, receive by the exporter before sending the goods. And in case if it is a huge amount, it will be getting guaranteed. Uh, Guarantee will be given. That why this guarantee is I have paid already. You have to supply the goods on time. Then, if the exporter is in a strong trading position, then sometimes cash in advance is also not required. You can skip for the next one. Then the next one is documents against payment. So what is DAP? So when the importer's bank sends a collection notice to the importer pays the amount after taking the possession of various documents. So documents against payment. So when you want make payment to be made, certain documents should be settled or submitted. So documents against acceptance, documents against payment. So documents against acceptance is when the when the importer's bank sends a collection notice to the importer gives the acceptance to pay the later date. So later date will be given later. So you'll be paying on the next coming future date. So for making a payment, you have to open an account. So for opening account, this is the process: ship the goods, forward the goods directly to the buyer, and wait for the payment. So you have to open an account. That is very important for the importer. Open the account, ship the goods for first, forward the shipping documents, and wait for the payment to be made by the importer. Then the letter of credit, already we have discussed. Letter of credit is a document for payment opened by a party wishing to import, and the communication will be between the importing bank and the exporting bank, so that they'll be asking the payment to reach the particular destination on time. Then who are the parties who will be involving in letter of credit? Applicant is the importer, then exporter, issuing bank, and the confirming bank, intermediary bank. So this is how it works: applicant, importer bank, exporter, uh, and the intermediary bank. So advising bank and issuing bank will be doing the main role. Seller and the buyer, they have a transaction from one country to the other country. So when it is which mode of payment you are going to make the transaction, that should be properly informed to the opposite party. So documentary credit cycle, this is how it plans. So you will be uh, getting the intervention from the government also. So proper monitoring will be done by the local financial institution and government organization when you do trade between two countries. So exporter is a seller, importer is a buyer. So they will have the importer's bank in between. So importer's bank will be issuing letter of credit and open an account, properly send the goods to the importing country, and then finally wait for the payment in the exporting country. So that is how you will be carrying out the transaction in letter of credit. So these are the documents, that is payment terms you have to know in international trade. So open account, letter of credit, document against payment, documents against acceptance. So these are the various payment terms we have to know under international trade. Any doubt in this? I'll move on to the next one, or we'll stop now. Any doubts? Okay, we'll continue in the next class in the next week. The remaining things.
Okay, ma'am.
Okay, thank you.
Thank you, ma'am.
Good afternoon. So
Ma'am.
now, as we discussed in the first hour, we are seeing the subject called merchant banking and financial services. That subject, in the first hour, we saw about the first unit, and now we'll see the second unit of it. Let me share the presentation. Now, in your the second unit of the subject, which talks much about the merchant banking. In the first unit, we saw what the financial services and what are the different services which is being provided, what are the instrument or what are the different fund-based and non-fund-based um, services being provided. We saw that. Now, we'll see about the merchant banking, its intermediaries or its activities, its procedures, and all those things. The entire unit talks about the merchant banking. So there is only two classification in this unit number two. One is about issue management intermediaries, and the second one is issue management activities. Intermediaries is the organization that will be dealing with activities and procedures, much talks about the rules, regulations, or the thing that needs to be followed. So we'll see one by one. And the first one, the issue management intermediaries. So only these two topics is involved in the second unit. One is this intermediaries, and the other one is this procedures and activities. First, we'll see the issue management intermediaries. Okay. Now, the various intermediaries in the merchant banking are these eight eight things that is given in your book in page number 40. The various intermediaries. Now we said, like we saw about the merchant banking. What is the merchant banking is? The merchant banking is actually which is started earlier in the year 1969. Now, the main function is that they concentrate on providing the financial assistance and they protect the investor, and they comes under the Security Exchange Board of India. So, certain many financial assistance and the services which is being provided by the merchant bankers. Now, among that, there are many market intermediaries in the issue management. Under that, the first one is the merchant bankers. So these are the eight things which is given. We may call them as the intermediaries, which is dealt in the issue management, like while issuing the shares or while issuing or entering into the market. These are the various intermediaries you will be seeing it. Now, what is their role? What is their function? What is their regulatory norms which is being followed? So, the role of these intermediaries will be dealt in this topic. Now, the first one is the merchant bankers. In a book, in each and every heading, they talks about their registration process or functions or the responsibility or the appointment. So, n number of topics is here in each and every heading, in each and every subheading. So make a note of it and understand like what is being dealt in each and every topic. Now, in merchant bankers, we are going to see about. We will see the first one, the merchant banker. In merchant banker, we are going to see about what it is, the category, the fee payable, the fee conditions, and the fourth content is functions. So in the first topic called merchant banker, we are going to see four subheadings about what it is, the category, fee payable, and the functions. So first, the merchant banker has four subheadings. Now the first one, what is the merchant banker? The merchant banker is a person, or he may be the institution, or he may be an organization or company who will be engaged in doing the business of issue management. Like they will be helping in the issue management. How they will be helping? They will be making certain arrangements like buying, selling the shares, or subscribing the shares, or acting as a manager, or acting as a consultant, or acting as an advisor or any such activities like rendering services. So whatever work you are doing for issuing your shares, the assistance or help that is being done by a person called a merchant banker will be dealt in a number of activities. So such a person is called merchant banker. His help may be of any field. Either he may come and help you for selling, come and help you for buying, or come and help you for subscribing shares. So his task is to assist in issue management. So such a person is called as a merchant banker. The merchant banker can be a company, an institution, or even a banker also. Okay, understood the concept of merchant banker? Now, that merchant banker is classified in four different categories. That is, the merchant banker, they fall under category 1, 2, 3, and 4. You have four different subcategories. What type of merchant banker comes under category 1? Category 1 means the merchant bankers, they carry all types of activities. They will be dealt in purchasing, selling, subscribing, providing assistance, providing the consultant facilities or whatever the facilities or the service that is being provided, such type of merchant bankers comes under or fall under category 1. So they will be providing all such activities related to issue management. But who are all the type of merchant bankers who comes under category 2? Category 2 of merchant bankers may act as an advisor, consultant, underwriter, and the portfolio manager. They provide assistance or they provide only the decision making process. They won't buy for you, they won't sell for you, but they will only provide advice or they will consult you. Okay, so that is the second category. Third category of merchant banker may be called as only the underwriter, only the advisor. Okay, so that is the see the like the category will be reduced from category 1, 2, 3, and 4. First category covers all the activities. Second category provides the act as advisor, consultant, underwriter, portfolio manager. But the third category, they act as only underwriter, advisor, and consultant to the issue. But the fourth category of merchant banker, they only do only two services or two services being rendered. One is they act as advisor or the consultant. Only advice is being done. Okay. So these are the various categories. So the merchant banker category has the four different headings. So one, they provide all services. Two, three, four, or n number of services being provided, and that is being reduced from category 2 and then 3 and then 4. Okay, this is about the category of merchant banker. Now, the fee payable. The merchant banker, they have to register themselves under the D and they need financial services. So you need to know much about the merchant bankers, its functions. So there are a number of functions, around 12, 15 functions are given in your book, but I have listed certain which make you like to understand easily. So these are the service types of service or the function that is provided by the merchant banker. The first one is the corporate counseling. So the merchant banker do or they provide advice to the corporate unit or the corporate means the company. They provide service to the corporate unit at free of cost, even at free of cost they will be providing. So for the corporate, it is providing counseling. Counseling means like giving guidance, giving advice, like what to do and what not to do. Okay, that is the first function is being provided by the merchant banker. That the merchant bankers are providing services, guidance, counseling to the corporate. Okay, they arrange funds or they monitor their actions and they help in providing financial assistance. All these n number of activities are being provided by the merchant banker. That is one function. The second function is project counseling. Like the corporate counseling, the merchant bankers provide project counseling. How the project counseling is done? They will do feasibility study. Like feasibility studies, analyzing or making assessment of the project. The project is being assessed, and all those things is done by the merchant banker. So such type of service is being provided, or such type of function is provided by the merchant bankers. So they will do feasibility study or they will assess the project. So first, what they will do, they will go for identifying the project idea. They will study the feasibility analysis and they go for submitting the project report. So they will review and conduct all those activities which is dealt in the project. So all such activities will be provided by the merchant bankers. That is second function. And the other one is pre-investment studies. Pre-investment studies is like identifying various financial avenues or the financial alternatives. See, you have n number of financial alternatives or financial avenues which is being available. The merchant bankers, they go for identifying a detailed feasibility study to evaluate various number of financial alternatives for making investment. So you have a number of investment alternatives. You can go and get loan, invest in loan. You can buy shares, you can buy debenture, you can put your amount in fixed deposit, you can buy land or whatever. All these are various investment alternatives. But which one should be dealt or which will be the best one? That the assistance or that help can be rendered by the merchant bankers. So it will give an idea like on which you should invest your fund. That is one function which is being provided by the merchant banker. Another one is credit syndication. It is a long-term loan for the borrower. Like the merchant bankers provide the credit facility in the form of organizing or procuring certain funds from various financial institutions. Like we saw in the previous unit, right? The loan syndication, loan syndication, credit syndication, both are same. Syndication means the group of bankers or group of institutions they come forward to provide you the financial assistance. If you if your amount is such a big amount and if that is not being provided by one individual bank, the bank will get help from all other banks. They, as a group, provide fund or provide loan to you. So that is called loan syndication or credit syndication. So it is a combination of different banks or different lenders, and they combine the form together and they will provide loan to you. That is called loan syndication. We saw that in the previous unit also, right? So such service is also being provided by the merchant banker. So the merchant banker may act as the loan syndicator. They will provide this type of functions also. That is one. Other one, issue management and underwriting. Issue management and underwriting, like what is called underwriting. When the number of shares is not being sold out in the market, then the underwriter's responsibility is to buy those unsold shares. So even the merchant banker acts as an underwriter in the issue management process. They will buy the unsold shares in the market. Okay, so then only you can go for the next step called the allotment. So getting into this step called allotment, first all the shares should be sold in the market. So the merchant banker acts or they function as an underwriter also. Portfolio management. Portfolio means it's a set of securities, a set of shares. If you buy a share from one company and another share from another company, like this, if you are buying n number of shares from n number of companies, then all those shares togetherly, collectively called as portfolio. The merchant bankers playing a role of managing your portfolio. Okay, so that is one function. And the next one is working capital finance. Working capital is the amount which is needed for day-to-day operation. So that is called working capital. That day-to-day operations amount or the fund is being provided by the merchant banker. If you want a certain amount for day-to-day operation, there is a concept called working capital finance that is being provided by the merchant banker. This is another function. And the next one is venture capital financing. As we saw in the previous unit, venture capital means the capital or the fund is being provided to you if you have a new project, innovative project where the bank is not ready to provide finance. Then you can go for venture capital and get your amount and you can go ahead for your innovative project. And the last one is lease financing. And this also we saw in the previous unit. Lease financing, it is an agreement between two different organization or the person where one is giving its asset to be used by the other person called leasing. On what basis? On rental basis. So by paying the rent, you can use the asset. And the merchant banker provide leasing facility also. So the merchant banker involves all the service providers. Merchant banker can provide n number of services. Either he may provide venture capital financing, he may provide leasing financing, he may provide portfolio management, he may provide loan syndication or whatsoever. Various all these types, all these functions will be provided by the merchant banker. Okay, all these are the function that is provided. You can try to know about at least 10 functions so that if all the class in the question you can write because it's an important question, the functions of merchant bankers. Next one is lead manager. Like coming back to our topic, we are in which topic? We are seeing the issue management intermediaries. In that we have 8 headings. On that 8 headings, the first one, the first subheading called the merchant bankers. We finished that one. Coming back to the same heading like issue management intermediaries. The second one, the second heading is the lead manager. What is lead manager? Now, what is the role of lead manager? The lead manager can be the bank or underwriter or any other fund-based intermediaries. What they will do, they will be coordinating the activities of underwriting. Okay, so they'll be doing such a work like they'll be coordinating the issue management and the lead. There is a person called lead manager under whom there is another person called the syndicator or the group of underwriters. The lead manager is the head for the underwriters and they will be guiding all other underwriters. Now here you have some the responsibilities or the work or task that should be represented by the lead managers. There are a number of topics like how many number of lead managers should be here or what are the conditions for the registration of the merchant bankers are dealt in this second point called the lead manager. But we are seeing like what should be taken as the important concept. So I've taken like lead manager. We saw who's the lead manager, and we are going to see about the responsibilities of the lead manager or the work which is being done by the lead manager. So every lead manager must sign an agreement with the issuing company. So you need to sign the agreement with that of the company, and if that agreement form should be, and that agreement form, that should be shown to the SEBI, and that should be submitted to the SEBI. If you signed, then that should be submitted to the SEBI, and there should not be any association between the lead manager or with any other person. You should not have an association in between yourself with any other person. Okay, so whatever you do, that comes under the concept of lead managers. So there should not be, that is given in the fourth point. There should not be association, or there should be no association between lead manager and the issuing company. You should not have the association. Just you are submitting and moving around. Then the other functions or the responsibility is the minimum undertaking obligation to be accepted by the lead manager is 5% of the total underwriting commitment or rupees 25 lakhs, whichever is earlier. Okay, these are certain responsibilities or the functions which is being performed by the lead manager during the time of issue. And coming to the exact topic called the underwriter, the third heading, underwriter is a person who will be buying, as I said already, underwriter is a person who will be buying the shares. What shares? That is unsold shares. The unsold shares are being purchased by the person called underwriter. So they will make arrangement accordingly. So if the shares are not being sold out in the market, that is being bought by the person called underwriter. Now, how they are being appointed? The issuing company in consultant with the lead manager or the merchant bankers to issue appointment for the underwriter. So they need to consult to more person, and then only they can appoint the underwriter. The underwriter assets must be adequate to meet their obligations. So now when the underwriter is being appointed, his asset should be of greater value, because if something went wrong, then the underwriter has to pay for it, right? So that is one appointment. The registration and to act as underwriter, the certificate of registration is compulsory, and you need to get it from the SEBI. Now, what are the fees that is being paid to the SEBI? Application fee again the same 25,000, and the registration fee is 10 lakh. And for reviewing that application, you need to pay rupees 5 lakh. Okay, so these are about the issue management, about the underwriters or underwriting procedure. Then the next heading is banker to issue. Banker to issue, like merchant banker act as a banker in the issue process. If you, if your shares are being sold out in the market, and the people will be buying, so you need to collect application money. Then you need to money, you need to collect the allotment money, and you need to refund if the asset is, sorry, if your share is overbought, and you need to collect the money which is due. So all these things will be done if you have a banker to issue. The merchant banker acts as a banker to issue. So all these headings we are seeing that the merchant banker acts like these and these categories. Merchant banker acts as a lead manager. He acts as underwriter. Now he is acting as a banker to the issue. So whatever the task that is being done by the merchant banker, he has to accept the application. He has to collect the application money, and he has to refund the application money when the application is uh, bought in excess by the public. This is one function. And how it should be registered. Everything, whatever that is being done, it should be registered by, or you need to get the registration from the SEBI. What are all the obligations or the duty? What are all the duty and the responsibility? So the main first duty is to furnish the information to SEBI. So you need to, whatever you are doing, you need to submit the information whatever we are doing, you need to submit the information to the SEBI, and you have to maintain the accounts, and you need to enter the agreement that is in the n number of notes, many notes that is given in your book. See to it, select a particular topic. If you want to say about the registration, select the topic. If you want to say about the requirement, if you want to write about the obligation, pick particular topic and read on a choosy basis, because more content is there, n number of content is there. So in each and every heading, you need to know about its concept and the background around it. So select a particular topic and be choosy in your topic. Like whichever you felt easy, you can select and read. So see, and given only the small content, if see the book to the vast content is given, and that is well and good. You can rather than browsing this subject, this content notes is well and enough for you for your preparation. The next one is broker donation. The merchant banker acts as a broker. So what are all the brokers' job? They need to help the investor in investing. They need to be doing what sort of help that is being availed by the investors. Mainly the concern with the purchasing of the shares. So whatever the investor says, the broker has to do. How they are being appointed? The appointment of broker is not the obligated. It's not that much difficult, and there is no restriction to the number of brokers to be appointed. So there is no restrictions. You can appoint any number of brokers, and the brokers, if you are making use of the brokers or you are getting assistance from the broker, you need to pay a certain cost or the rate for it. The brokerage rate is 1.5% for all types of securities, and the broker has to meet the cost and other expenses from their own pocket for making the public satisfied. The company will not pay any such expenses. So they have to charge a separate cost as a brokerage cost or brokerage expenses or a brokerage percentage rate. Okay, and nothing can be shared by the company. Then the next one is registrar to the issue. The merchant banker acts as a registrar, ROC, registrar of company. They even act as a registrar of company in the issue management. What type of work that is being done, or the functions, what are all the work they will do here as a registrar? They will collect the application. They have to have a proper record of that application, and they need to go for the next step called the allotment. When the application process is over, you have to go for the allotment process, and finally you have to finalize or fix the final allotment. And if that is over, allotment is done, you have to dispatch that allotment letter, or you have to refund your money or the certificate or all other documents. So as a registrar, you have to do all these work, like merchant banker acting as a registrar, and whatever you do, you need to register under the Security Exchange Board of India. And the next one is debenture trustee. Merchant banker acts as a debenture trustee. Now, who are all eligible to be as a debenture trustee? Trustee is a person, a trust person who will be securing the issue of debenture, right? The debenture, if it is being used, there will be a person who will be termed as a trustee, and the trustee may be a bank or any other institution, or even the insurance company also maybe may act as a trustee. And there are other certain persons who are not eligible to act as a trustee, that is given below. The debenture trustee cannot act as a trustee if it is an associate to the body corporate, or if it has lent money, then you are not eligible. And if the loan is not fully repaid, then you are not eligible. And if it proposes to lend money to any other body corporate, then those institutions or those organizations are not eligible to act as a debenture trustee. The final topic in the first heading, like the issue management intermediaries, is the portfolio manager. The portfolio manager, I said portfolio means that it's a group of securities that is being managed. If you buy a number of securities from multi companies, then collectively they may be called as portfolio. Now, there are certain person called the portfolio manager, that is the merchant banking act as a portfolio manager. Portfolio means the total holding of the security of a person, and the portfolio management is responsible for everything, like for the funds asset, for managing it, and for the daily day-to-day trading. And again, here you need to register and get the certificate of registration. And for that, you need to pay application fee of rupees 1 lakh and registration fee of 10 lakh. And you need to renew that registration by paying 5 lakh rupees. And the renewal period is availed, or that is valid only for 3 years. And whatever work you do and everything falls under the category or under the procedure of PCP. Okay. So yes, the eighth topic which is given in your book as a issue management intermediaries, eighth topic which is given in your book in page number 40 and 41, and we finished those eight topics now. So it's a vast heading, like you can you can be choosy, and collectively you can read the content. Now let me move on to the next topic, the next lesson, that is 2.2, that is issue management activities and procedures. This is also a very bigger topic, wider topic that's being covered, and that's there in your book, page number 68. So what are the activities or procedures that's being done at the time of or during the issue? Now we'll see one by one. We have totally 11. The first one is about the eligibility norms. This is given in your page number 69. You can refer that. Mm. Now let me talk about the first one, eligibility norms. So you can underline and like have a note of it, because if you read one by one, like you'll be confused. So I've given only just a hint. If you are writing the entire 11 topics with 5 to 6 points in each and every heading, that is well and enough for your exam. About the eligibility norms, the company has to fulfill certain conditions. So I've given the 6 points. Like the company should have, like the eligibility condition. You need to have this to be satisfied. Then only you will be eligible to issue the shares or offering the shares in the market. The first one is like you need to have the asset value of 3 crores, and you need to have the profit of at least 3 out of the five preceding years. So out of 5 years, at least for 3 years, you need to have the profit. Okay, that condition should be fulfilled, and your net worth should be of 1 crore in each of the preceding 3 full years. In the preceding 3 years, your net worth should be at least 1 crore. And in case of any change in the name, if you want to change your name, then you need to have at least 50% of the revenue. Then only you are eligible to change your name. And the total of the issue should not exceed 5 times its previous issue's net worth, and the minimum post issue capital should be, so after your issue, the post issue capital you should have at least 10 crore in hand. So these are the conditions. If you if you if you have all these things satisfied, then only you are eligible to issue the shares. Okay, this is one condition. There are an exemption that is given in your book, and the public issue by the limited companies and unlimited companies, which is given separately in your book, right? So this is one. And the second heading is pricing of the issue. like while pricing, like while fixing the price for the issue, what are the condition you need to satisfy? You need to determine the price of the securities in consultants with the merchant bankers, or you can do with the book building process. Book building process is a separate heading you'll be seeing in the upcoming points. Book building is the process like getting the price from the investor itself. So you're not fixing the price like the shares is sold for rupees 100. You're not fixing the price 100. Whereas in book building process, you'll be asking the investor at what price you want the shares. So some will be telling 100, some will be telling 120, some will be telling 80, some will be telling 50. So you'll be collecting all those price from the investor and you will fix the range of it. Okay, so you'll be fixing one price. So that process is called as book building process. So you can fix the price with the method called book building process, and the insurer shall undertake the book building process or with the help of the merchant banker. So the pricing should be done with the help of book building process. Then promoter's contribution. The promoter, like promoter is a person who will be doing each and every activities of the company's formation. So promoter is the first person who do the work or the task for the formation of the company. So what is his contribution? If I'm the promoter, if some organization acts as a promoter, what they have to do? The first one, the promoter should bring their contribution. So they have to bring contribution from their side, and the contribution would be kept with the bank, should be kept with the bank, and the contribution will be released to the company along with the public issue process, and they should be allotted. The promoters should also be allotted, okay, by passing a resolution in the meeting. Okay, so promoters' contribution is very, very important in the issue process or in the issue process activities. And the next one is about the Indian Depository Receipt called IDR. So this is an instrument, or we may call it as a depository, that is created by the domestic depository in India. That is the issuing company which is being incorporated outside India. So if you are issuing and that is done outside India, then you need to have a depository receipt for your transaction. Okay. Now, what is the procedure for it? What should be done for using this? To raise the funds in India by issuing IDR, you need to get approval from SEBI. So whatever you do, you need, as I said, you need to get approval from the SEBI. That is one point, the procedure. And the other one is the issuer must obtain necessary approval from the appropriate authority from the country of the corporation. So to which country you are dealt with, in which country you are dealing with, you need to get approval. And in your own country, you need to get approval from the SEBI, and you need to get the appointment over the bank, which is uh, overseas bank, that is the other country's bank. You need to get approval, and you need to deliver the equity shares to that overseas custodian bank, and that bank should be authorized by the domestic depository issue, that is IDR. So you are linking, like IDR is linked with the depository bank or the custodian bank, overseas custodian bank in other countries. So they need to follow the rules and regulations which is stated by the ROC, Registrar of Company, and also the SEBI. So Indian Depository Receipt means you are dealing with the issue company that is being incorporated outside India. So outside India and inside India, and you need to satisfy both. Here the SEBI, here the ROC should be satisfied by your activity, and you need to deal. If you want to deal, you need to get approval from the bank which is there in the other country. The other one is issue advertise. Issue advertisement means whenever you want to issue your shares, you need to advertise that either in the, it includes certain other facilities. Like you need to advertise either in the notice or by way of brochures or pamphlets. It can be of circulars, show cards, catalogs, or any other play card, poster, picture, films, or any other medium. Either it can be in the radio, it can be in the television, or it can be of any printed material whatsoever. You can use any type, and you need to advertise that you are going to issue certain number of shares or certain number of uh, debenture or whatever it is. You need to advertise your issue. Okay. Now, why this has to be done? So, what is the feature of it? Okay. So, while advertising about your issue, that information should be, so you are giving an advertisement in the circular, okay, or in the film as an advertisement, or in the newspaper if you are giving, those information should be clear and truthful. Misleading information, misrepresent information, false information should not be given in the advertisement. So that is given here. So your information should be clear and true, and you should not disclose any irrelevant facts. All your information should be relevant, and it should not contain any promise like you'll be increasing your profit. You should not promise anything that I will be doing this or that in your advertisement, and it should not be misleading or any false or fake information. And in your advertisement should not give certain information like offer document. So in your advertisement, you need to provide information. That's it. You should not go like providing certain offers, right? And the advertisement, in case of advertisement on television screen, then you need to say about your risk factor also. The risk procedure also you need to give, and your advertisement should not give any issue slogan. Like for your issue of shares, you should not say any slogan for it. Okay, no issue slogan should be included. Now the next one is about the issue of debt instrument. We saw what is debt instrument in the previous unit, right? New financial instrument. We saw the debt instrument. Debt instrument, you have a number of debt instruments. So you are issuing certain debenture or bond that is being either it can be issued by the government or any other statutory body, whoever it might be. Again, they need to be specified, and they need to follow the procedure which is stated by the Security Exchange Board of India. Okay. So either you can issue by the public issue method, or you can issue by the private placement method. Public issue means you are issuing the shares to the general public. Private placement means if you want to issue 100 shares, rather than getting into the public issue, you can select certain private people, a bank, or any other financial institution, insurance company, leasing company, or whatsoever, you are private people. So you are issuing the 100 shares to your own known people, institution, or organization. So then such type of issue is called as private placement. You can choose any number of methods, either of the public issue or the private placement, and the procedures, conditions for the public issue separately and for private placement separately, which is there given in your book. I have not listed those conditions. The issue requirement for public issue separately, the issue requirement for the private placement separately. It's given in your book, page number 80, therefore page number 80 here. And the listing of debt securities. And here your debt securities should be listed in the stock exchange, and that listing is kept or made it compulsory. Now from, as I said, like book building. Now book building is, as I said, book building is one type of issue where price is not fixed. where price range is fixed. While in the book building process, if you are issuing the shares, you are not fixing the price. Whereas price range is fixed. Like you can quote like price equal to rupees 80 to 120. You can fix the range so that if I'm the investor, if I want to buy 10 shares for rupees 80, I can buy at the price of 80. If there is an investor who wants to buy for rupees 120, he may buy. There are investors who will be buying for 90 rupees, 95, 100 or so. So you'll be fixing the price range. After that is being issued and the process is over, then the company has to select a fixed price between this 80 and 120. That process is called as the book building process. We'll be issuing the shares with the range. After the shares is being issued, you will sit and calculate like at what price exactly it can be sold out. So after fixing the price, the next procedure called the allotment happens. Okay. So allotment, if I am getting, if I bought like the 5 shares for rupees 80, if that is being allotted, then I may get. If that is being not allotted, like if if that is being said like we can only buy for rupees 90, then I need to buy for 90 rupees alone. So after the issue process is completely over, the company go for the allotment process. The next one is called about the green shoe option. Green shoe option means it is allocating the shares in excess of the already existing shares. So that is called a green shoe option. It is allocating the shares in excess of the shares which is being included in the public issue. It is issued when the public demand for those shares. If particular number of shares is not enough, then at that time, then you can issue in excess. Okay. So you need to have the underwriting agreement and to grant that to sell more number of shares which is being planned. Okay. So it reduces the risk for the company issuing the shares that allows the underwriter to have buying power to cover the short position. If you are issuing 1,000 shares, if only 900 are being sold into the market, the remaining 100 shares will be purchased by the underwriter. So this concept you know. And if you are issuing 1,000 shares and people are in need of 1,200 shares, or 200 more shares if they need, then you go for choosing this green show option. So providing the shares in excess of the original shares. The next one is EIPO, that is the initial public offer through stock exchange in online mode. That is EIPO. So that is everything, whatever we saw, like issue of shares and all those things that is done electronically through a database, through the facility, right? So why this is being done? What is the main advantage of the features? The multiple user can access this and the multiple facility. You can buy bulk shares without any problem into it because everything is being centralized and that is being having as a database. So bulk files can be done through online mode, bulk transaction can be done through online mode. So this is a very good option that is being provided. Then the next one is the preferential issue. Preferential issue means like issuing shares to a selected group of persons. As I said, and private placement basis. Private placement means privately on my own private people, I may select certain companies, individual investors or institutional investor, banker, insurance company, or whoever might be. I may select on my own preference, my own preference. So that is called preferential issue. I prefer this company to buy my shares. So I may give the shares to them. I prefer my friends to buy my shares, so I'll give shares to them. That is called preferential issue. preferring certain people for buying your shares, and that need to be governed by all those conditions which is being dealt with that. So you need to fulfill the conditions. And the last one in your heading, the second heading, the activities and procedure of issue management, it is qualified institutional placement. That is QIP, qualified institutional buyers or the placement. This is same as the private placement only. On the private placement method, or giving importance to the private placement basis, you are buying or you are placing your shares with the help of QIP. And here also certain condition you need to fulfill. The private placement should comply with certain requirements of the Companies Act. You need to follow the procedures which is stated by the Companies Act, and for that you need to have the issue size of rupees 25 crores for two, and if it is for five, you need to have 50 crores. So certain conditions which is given, you can like go through it and see to it. So these are the different headings we saw in this unit. So to simply calcify, and I say like in issue management intermediaries, we saw 8 subtopics, and in management activities, we saw around I think the 11 topics. Everything is coming under this unit. So in your second unit, we saw about two different broad headings. That is about issue management intermediaries and issue management activities and procedures. So your second unit is over. Like see to it all the side headings and make a note of it, and you can prepare well for your exam, right? So by next Saturday, we'll be seeing with the other remaining units, like the third and fourth unit. Okay, thank you very much. Thank you, everyone. We'll see you on next Saturday. Thank you.
Thank you, ma'am.
Okay, Miss Karthika. Uh, Hello, Ajit. Okay, only two have joined. What about others? Am I audible? Hello, anybody inside? Shall I wait for the people or take the class? See, Karthika. Hello.
Sir,
Ma'am, student only two and only, I think Ajit is a student, maybe. What about others? Are you staff or student, ma'am?
student, sir.
Okay, okay. What about others? What is the strength
They
of
went to eat lunch, sir.
okay? Only how many have joined in the last class?
Around 12, 13, think so.
Okay, okay. Shall I wait for some time?
Okay, sir. We may start around 2, 5.
Okay. 2 5 2 10. Okay. Okay, I wait. I wait. Okay, ma'am. Thank you. Okay, one is left. I think no class. Uh, he think like that. No classes. That's why he left. So I start the class. Okay. Yesterday we have discussed how to prepare budgets. What are its uses and how the committee and other things are formulated before preparing the budget. Then we discussed the preparation methodology of various budgets related with the functions, particularly sales budget, production budget, material requirement budget, material purchase budget, cash budgets. All these were discussed in detail. Today, I want to discuss with you the preparation methodology of flexible budgets. The business organization prepares two type of budgets. One is they prepare budget for particular number of quantity or particular level of activity, say 50% activity, 75% activity, or only for 5,000 units. The company estimate the budget, estimate the expenditure in production of 5,000 units only. They do not bother about lesser quantity. They are not taking care of higher quantity also. So they are very particular to the particular number of quantity. So when the expenditure was estimated for the particular number of product, particular number of units, it is called fixed budget. On the contrary, the other side, the business organization prepares or want to know the cost of production of different quantities. Say, for example, when the company produce 4,000, what is the cost? Or what is the total cost? When the company choose 5,000 units, what is the cost? 6,000 units, what is the total cost? Then the company decide which quantity is opted for the year. For say, for example, if the company has well resources, they go for higher quantity. If the resources are very tough, very scarce, limited, then they go for the limited, lesser quantity. So, but before choosing the level of activity, they want to know the expenditure involved on different level of activity or different level of quantity. This is the conditions we applied to prepare a flexible budgets. The objective of the preparing flexible budget is this. So the company, based on the expenditure, they choose particular nature. Say for example, in our practical life also we do that. So if the cost of the, you want to donate food to needies, if you are asking the hotel manager, I want 50 packets, how much? 60 packets, how much? 70 packets, how much? Okay. So what is your money balance? Okay, it is equal to 50 packets. Okay, you buy the 50 and give it, donate that. The same way, the business also organization also wants to know different cost structure, and then which one is suitable to the business, they will adapt in the particular year. Okay, that is a flexible budgets. So we will see two budgets, fixed as well as a flexible in this class. Okay. Then another one things you want to, when you prepare a budget, flexible or fixed, the expenditure involved in production must be classified into three categories. classified into three categories based on their behavior related with the output. The first classification is variable cost. The three classification are variable cost, fixed cost, semi-variable cost. Variable, semi-variable, fixed. The variable cost means the cost is the total cost is vary according to number of mm, okay, sorry for the disturbance. A call from university. That's a problem. Okay. Um, okay. I thought I'm talking about the classification of expenditures. Variable expenditure. It vary according to the number of units. When you buy one shirt, 500 rupees. You buy two shirts, 1,000 rupees. When you buy three shirts, 1,500 rupees. The total cost is different from one because of the number of shirts you bought from the club center. Say one thing, the total cost is changing. But in this case, you see that it is very useful to marginal costing also. You remember this. The total cost of variable cost will change. That is 500, 1,500. But per unit, when you take you are buying one shirt, 500 by one, 500 rupees. When you buy two shirts, 1,000 divided by two, 500 rupees. When you buy three shirts, 3 for 1500 divided by 3, it is 500. So per unit cost of variable is remain constant or fixed. So you identify the nature. So variable cost means the total cost vary, but per unit cost remain constant. Okay, go to the next one, semi-variable cost. It means it consists both fixed and variable. To some extent, it is fixed. After that, it turns as a variable cost. How does this possible? Take the bus fare. So up to 5 kilometer, 1 kilometer or 2 kilometer, whatever the destination you want to get down, you have to pay 10 rupees. Up to 5 kilometers. After that, the bus fare will be levied based on the kilometers. 10 rupees plus 1 kilometer cost. 10 rupees plus 2 kilometer cost. So after that only the cost is vary according to number of kilometers you are going to travel. So that is a semi-variable cost. Take there are so many exam exam amount also semi-variable. So if you application cost, mark sheet cost are constant for all. If you have one subject amount is added. If you have two subjects, two subjects amount added. If you have seven subject amount is added. So up to the time level, application money, mark sheet is a fixed money. Ma'am, hello, any doubt? Okay, application money and what is called application money and mark sheet is a fixed one, but the amount for per paper, exam fees for per paper may be different. It is variable. If you have one paper, you pay 200 rupees. If you have two paper, you pay 400 rupees. It is variable. So both the fixed and variable nature are involved. So it is called a semi-variable cost. Another one is fixed cost. The fixed cost remain constant irrespective of the output. Take house rent. If you are two-person living in the the house rent is 5,000. If you have, if you are living four people in the house, 5,000. Sometimes 10 people are, some guests came inside and 10 people occupy the house, the same 5,000 rupees. When there is no person inside the it is locked, the our house is locked and left for your place, then at the time also you have to pay 5,000 rupees. So irrespective of number, the same amount is paid. That is called fixed cost. So I am paid 1,000 per hour. Suppose you think like that, 1,000 per hour. If 5% joined, 1,000 rupees. If 20% joined, 1,000 rupees only. And then 50% joined in the classroom, only 1,000 rupees. So the number of students not increasing my remuneration amount. So it is called fixed cost. So I think you understand these three things, variable, semi-variable and fixed cost. Understanding of these three things is very useful for preparing a fixed and flexible budget. Now I share the
Sir, your sound is not audible.
I think mic off.
Uh,
Sir, you turn on your mic, sir.
oh, okay, okay. I'm sorry. When I talk with remaining 10 minutes, nobody is. If voice is not audible, please inform.
I think you make another call, then only.
Okay, okay, okay. I'm sorry. Uh-huh. 10 minutes I am talking. uh, okay, okay. So okay. It's okay. See, I repeat once again. Uh-huh. Okay, I repeat once again. Mm, waste of time, I will say. Okay. See that when you prepare a flexible budget, I elaborately explained what is variable expenses, what is semi-variable, what is fixed. I elaborately explained it, but not heard by you all because of my mistake. Okay. Variable expenses means it vary according to the number. When you buy one shirt, 500 rupees. When you buy two shirts, 1000 rupees. When you buy three shirts, 1500. The total cost will increase. But at the same time, per unit cost will goes down, will constant. For example, one shirt 500 divided by 1, 500 rupees. Two shirts 1000 divided by 2, 500. Three shirts 1500 divided by 3, 500. So per unit is remain fixed, but total cost is vary according to the number. So that is the nature of variable cost. And then semi-variable cost. It consists of two things. It consists of two things. That is variable as well as fixed. It has both of nature. So what is I talk about first fixed expenses. Fixed expenses means that expenses remain constant irrespective of number of units. Say for example, you assume that 1000 rupees paid by the university. Assume that, okay. If 5 members joined in the classroom, I will get 4000 rupees. 20 members joined in the classroom, I get only 1000 rupees. 100 members joined in the classroom, I get 1000 rupees. So the number of students joined in the class does not affect my remuneration. So it is fixed. So the amount is fixed irrespective of the students. So it is a fixed nature. But at the same time, the per unit of the fixed expenditure may vary according to the number. For example, 1000 rupees is paid, only 5 students joined. 1000 divided by 5, 200 rupees per student. When 50 students joined, 1000 divided by 50, 1000 divided by 50, there's only thing 20 rupees per head. When the 100 students joined, 1000 divided by 100, only 10 rupees per head. So 100 rupees, 200 rupees, 20 rupees, 10 rupees. The cost per unit getting down, getting vary according to the number. But the total fixed expenditure is remain constant. The total fixed expenditure remain constant. So that is the nature of fixed cost. Then another one expenditure is semi-variable. It has both nature. Some part variable, some part fixed. For example, your exam fees. Mark sheet and application money is constant. For mark sheet 100 rupees, for application 100 rupees, 200. If you have 5 paper, regular paper, okay, 5,500 into 100, 5 subjects into 100 rupees, 500 rupees. If you have arrear, 7 papers, 700 into 7 into 100, 700 rupees. So 700 plus 400, 1100. 500 plus 400, 900. The total vary, but it has two portions. One is a certain part, up to a certain part, it is fixed. After that, the amount will vary according to the number. Take the bus fare, up to certain kilometer, 5 kilometers, 10 rupees will be charged. 10 rupees is charged. After that only the kilometer per patient, travel passenger, the bus fare is charged according to number of kilometers. So up to 5 kilometers, 10 rupees only. You get down in the first one kilometer itself, you pay 10 rupees. So the second kilometer, okay, 10 rupees. Up to 5 kilometers, you have to pay 10 rupees. After that only, it goes little bit. For example, 1 kilometer. Suppose you are going 13 kilometers, then you are going to pay 13 rupees. So it will change accordingly. That is the semi-variable nature. Okay. First thing, when you are going to prepare a flexible budget, first identify which are variable expenditure, which expenditure are fixed expenditure, which expenditure are semi-variable. Semi-variable, you need not bother about it. In the problem itself, it is given 20% fixed. That means 80% variable. And then 70% variable, okay, 30% fixed. So it is given in the problem itself. So it is easy to identify. But in case of variable expenditure, you have to see that all the prime cost items are variable. All the prime cost item, that is already I explained in the first class, yesterday class. Direct material, direct labor, direct expenditure. All these three are prime cost. These prime cost item are always variable. So another thing, the variable portion of overhead, factory overhead, variable portion of administrative overhead, variable portion of selling and distribution overhead are all variable. So they mentioned in case of overhead, they give the note, it is variable or fixed, it is given. So you identify this. But direct material, direct labor, or direct wages, or direct expenses, all are variable expenditure only. The variable is vary according to the number. Okay, fixed expenditure, depreciation, salary, administrative expenses, general expenses, that are all fixed. So take these two. If you identify these two, the remaining part are all fixed, or some notes are given. So accordingly, you have to identify the nature. Then, now you will go for, okay, I'm sorry. Now you see that when you prepare a flexible budget, like this, flexible budget means a budget for different quantity. Budget is prepared for different quantity. The company will choose which is suitable to the company. Okay, they want to know different quantity and their expenditure, variable expenses. Under the heading, material, labor, direct expenses, other variable overhead are all taken. You see that 2 rupees, you think 2 rupees per unit of material. Take for 5,000 units, 5,000 into 2, 10,000. For 6,000, 6,000 into 2, 12,000. For 7,000 units, 7,000 into 2, 14,000. So per unit is multiplied by number of units. In some cases, per unit is not given. Total amount is given. Material 6,000 for 2,000 units. That information is given. So at the time, for 2,000, 6,000 is amount. For 6,000 divided by 2,000 into 5,000. For 2,000 units, 6,000 is spent. For 5,000 units, how much? You have to decide like this. And then same nature. Another one is semi-variable expenses. It has two portion. It has two portion, variable and fixed. Variable and fixed means you identify, it is given in the problem itself. You identify the variable. The variable is vary according to the number. According to the number. Say for example, here it is not usually calculated. For example, 5,000, 6,000, 7,000. You see that the variable cost is 1 rupee. 1 rupee. So for 5,000 units, 5,000. 6,000 units, 6,000 into 1, 6,000. 7,000, 7,000 into 1, 7,000. So the same way, the fixed expenditure is calculated and kept separately, 2,000 rupees for 5,000 units. The same amount is charged for 6,000 units and 7,000 units also. So you have to divide the semi-variable expenditure into variable and fixed. Then you go for accordingly. You have to some other expenditure are given. So you split them. There are two way of presentation. One is now I am variable cost is separately shown, fixed cost is separately shown. So instead of that, so some people use this. For example, total cost. We have to see that. Not able to type. So okay. Okay, Pa. Sorry, Papa. So sometimes they show that 5,000 plus 2,000, total 7,000. The 7,000 is recorded as they do it separately. Separately, they calculate everything separately and take the total 7,000. Factory overhead 7,000. And another one is another factory overhead for 6,000 unit 8,000. Factory overhead for 7,000 unit 9,000. They put like this. The consolidate amount also given. You can write or split the amount. That is two ways. Then fixed expenditure. The fixed expenditure is common to all levels. So say that depreciation is 5,000. It is 5,000 for all the units. Okay. Next. After that only you see that you find the total of each number of units. For 5,000 units, 21,000 total. For 6,000 units, the total is 24,000. For 7,000 units, total is 27,000. Now you have to write the number of units. Number of units you are going to in the top itself. You are writing the number of units. You bring the same 5,000 units. Then 21,000 divided by 5,000. The cost per unit is 4 rupee 25 paise. 24,000 into divided by 6,000. The cost per unit is 4 rupees. 27,000 by 7,000. The cost per unit is 3.86. So you calculate the cost per unit like this, and you note the one thing: when number of units is very lesser, the cost per unit is very high. For example, 5,000 units, the cost per unit is 4 rupee 25 paise. But in case of 7,000 units, the cost per unit is 3.86. This is because of reducing the fixed cost. This is because of the fixed cost. Because the fixed cost is a constant. So the earlier lesser number bear higher amount of fixed cost. But when the higher quantity bear only lesser amount of fixed cost. That is the reason for difference in prices. Okay, in the same way, you have to prepare a flexible budget. Now I am going to show one illustration problem. See this. Am I? Sorry. Okay. Okay. Is the screen visible? Okay.
Sir,
Okay. Thank you. Okay. See this, Nachar. I think it may be okay, not clear, but okay, manage it. Drop the flexible budget for the production at 75%. That is the capacity level, and 100% capacity on the basis of following data for 50% activity. The data are given for 50% activity. You are asked to prepare 75% and 100%. So you have the three column. You have three column. One column for 50%, one column for 75%, one column for 100%. So you have to prepare a budget according to the ascending order, not the descending order. Ascending order only used. Okay. Material, labor, variable expenses, that is bracket direct. All these three are prime cost item. It always variable. So 100 rupees per unit, 50 rupees per unit, 10 rupees. So now our work is multiply with the number of units. Okay. Administrative overhead, selling and distribution overhead. Selling and distribution overhead. Take these two. 50% fixed, 60% fixed. It means these two are semi-variable expenditure. So 50% fixed, that means 50% variable. 60% fixed, okay, that means 40% variable. So you identify these two are variable expenditure. But in the problem, the fixed expenditure is not given. Fixed expenditure is not given. So okay, no issue. The present production at the 50% level of activity, 1000 units are produced. 1000 units for 50% activity. What is the 75% activity? 1000 divided by 50 into 75. 1000 divided by 50 into 75. So divide it 25. 225, 50, sorry, 50 rupees. 50, 75 is divided by 3. Okay. Then you have to 500, 1000 divided by 2, that is a 500. 3 multiplied by 3, that is a 1500. So 1500 units for 75% capacity. 50% 1000 units, then 100% 2000 units. Then units are given. See that budget. Here the per unit is not necessary. Per unit you need not put per unit column in each cases. It is not necessary, but it is given. Okay. Material 100 rupees. 100 into 1000 units. 1 lakh. 50 rupees labor. 50 into 1000 units. 50,000. Variable expenses 10 into 10,000. Okay, 1000. 10,000 rupees. So the prime cost that is 1,60,000. You need not mention prime cost, variable. All these things are not necessary. You just classify into variable, semi-variable, fixed. That's enough. Then prime cost item 1,60,000. Okay. In the same way, go to the 75%. 100 rupees into 1,500, 1,50,000. 50 into 1,500, 75,000. 10 into 1500, 15,000. Go to the 2000 units, 100 into 2000, 2 lakhs. 50 into 2000, 1 lakh. 10 into 2000, 20. So you multiply the unit value with the number of units. Just one work. Okay, 1,60,000. Then administration expenses. Take this variable 50%. You see that administration overhead 40,000. 40,000. 50% fixed, 50% variable. See this, it is given for 50% activity, not for 60 or 70%, not for 100%. It is given for 50% activity. You take that, that is, you must keep in mind that which level of activity or which number of units that data are given. That is very important. 50% fixed. So for 50,000, 20 variable cost 20,000, fixed cost 20,000. Okay, it's okay. 20,000 divided by 1,000 unit, 20 rupees. And remaining fixed cost, okay, remaining 20,000 fixed, 20,000 divided by 1,000, 20. They arrived like this. For 70%, you have to calculate. How to calculate? How they put 30,000. 20,000 for 1,000 units into what amount for 1,500 units. So 20,000 divided by 1,000 into 1,500. So when you divide that 20 rupees, 1,500 into 20, 30,000 rupees. The same way you go for the variable cost. Variable cost only vary. See that for 100%, 20,000 for 1,000 units into 2,000 units into 2,000 units. So it comes around 40,000. 40,000 rupees. You multiply like this for variable cost. But fixed cost, that is remain constant. So 20,000 for 5,000 units, sorry, 1,000 units, 1,500, same 20,000, 2,000 units, same 20,000. You put right like this. Okay, that is one semi-variable cost was over. And then selling, that is a cost of production, that is a administrative overhead as per the cost sheet. As per the cost sheet, prime cost plus factory overhead plus office overhead, that is called the cost of production. They give like this. You need not give all the things. They present in the same way. And then selling and the distribution expenses. Variable 40%. It is given in the problem itself. 50,000 rupees, 60% fixed. 60% fixed means 30,000 rupees fixed. Remaining 20,000 is variable. So, okay, take this. Here, variable 20,000, fixed 30,000. Okay. Again, you have to convert 20,000 for 1,000 units into 1,500 units. What amount? You multiply like this. 20,000 for 1,000 units into 2,000. So multiply the same amount, 30,000, 40,000, because the both variable costs are same. That's why. Okay. Fixed cost 30,000, 30,000, 30,000. Okay. Now we distribute all the expenditure. Our work is add. When you add the total, you total the first column for 1,000 units, it comes around 2,50,000. And second, for 1,500 units, 3,50,000. For 2,000 units, 4,50,000. They are not.
Sir, sir, second fixed cost 50% for 75%, 1,500 unit. Then
Okay.
13 point how they come, sir?
Yes, yes. And that is okay. I have seen that. Okay, okay, that is a wrong one. Wrong one. Okay. You divide 30,000 divided by 1,500. 30,000 divided by 1,500. That equal to, oh, okay, same. You divide the number of units. Okay, first one is 30 rupees. Okay, second one is 30,000 rupees divided by 1,500 units. 1,500 units, it comes to 20 rupees. Third one is 30,000 rupees divided by 2,000 units. It comes to 15 rupees. Okay, it is correct one. I am also confused. Okay, first thing 30,000 units divided by 1,000 units. Here the per unit, first column per unit column. Per unit column, the total amount is divided by number of units. 30,000 divided by 1,000 units, 30 rupees. 30,000 divided by 1,500 units, 20 rupees. 2,000 units divided by 30,000, 15 rupees. I already told you the fixed cost remain constant, that is the total amount remain constant irrespective of output. But the per unit of fixed cost is vary according to the number. That is the nature. Variable cost, the total cost will vary, but per unit cost remain constant. Two character, you have to know the behavior of the two cost. Variable cost, the variable cost is varying. Variable cost, the total cost is varying. One shirt 500, two shirt 1,000, three shirt 1,500. Total cost is varying. But per unit, 500 divided by 1, 500. 1,000 divided by 2, 500. 1,500 divided by 3, 500. So per unit cost is remain constant. That is the behavior of variable cost. Fixed cost, I already explained to you. 1,000 rupees is paid as a remuneration. Okay, take it as this. If 20 students have joined in the classroom, 1,000 divided by 20, it comes 50 rupees. When 50 students come joined in the classroom, 1,000 divided by 50, it comes 20 rupees. In the first case, 50 rupees. Second case, it is 20 rupees. And third case, 1,000 rupees, 100 students have joined. 1,000 divided by 100, 10 rupees. So here the fixed cost is remain constant in total. The total fixed cost is remain constant. But per unit of the fixed cost is vary according to the number of units. That is the behavior of fixed cost. So variable nature. So that is the reason you want to say that 30 rupees must be put in the 1,500 and 30 rupees put in the column of 2,000 units. So that is not a problem. Here you see that 30,000 divided by 1,500 units, 30,000 divided by 2,000 units. The per unit will be differ. Fixed cost is per unit, it is differ. Total, it is not differ. It is constant. Okay. Are you clear now?
Yes,
Sir?
Yes,
Okay,
sir.
okay. Okay, sir. Okay, then the total cost 2,50,000 and another things. See that in my presentation, I total cost, next column number of units, next column cost per unit. But here they are using side by side per unit column. So in each content, each unit number of units, they have total column, per unit column. But for which only I take this per unit column in the last rate, number of units and cost per unit. So we are presenting in different way. That is 250 for 1,000 units, 233.33 for 1,500 units, 225 for rupees 4,50,000. So you identify that because of variable cost, fixed cost. The fixed cost will get reduced per unit, that will reduce the total cost also. Okay. Then shall I go for another one? See that sometimes one more problem or okay. Here you see that here in the first problem total amount is given, per unit amount is given. In the second problem, all are per unit information is given. You see that and the Gunal products produce and sells a product for which total capacity of 2,000 units exists, and 2,000 units can be produced. Okay. The following expenses are the production of 1,000 units of the product which is sold at 1,130 rupees per unit. The description of 130 units, 30 rupees, production cost is given. Okay, see that. So the company has the capacity to produce 2000 units. Now they are producing 1000 units. 1000 units informations are given here. Only 1000 units information. Direct material, direct wages. These two are variable. Okay, vary according to the number. Administration overhead, it is given constant. That means fixed overhead. It is fixed for all the level. Selling expenses, 50% fixed. That means semi-variable expenses, 50% variable. Distribution expenses, 25% fixed, 75% variable. That is a 20 rupees is given. Then you are required to prepare flexible budget for the production and sale of 1200 units, 1600 units and 2000 units. So you have you are asked to prepare three columns, that is 1000 for 1200, 1600, 2000 units, and you add one more column for 1000 units. That is the nature of problem. Here also in this per unit is given in the side by side, but I take on the last column, that is very easy. Instead of mentioning all the per unit in each and every item, the last one taking the total and divide. Okay, it is very simple. That's why I present like this. Then variable cost. You say that direct material 20 rupees. It is given in the problem 20 rupees. Direct wages 30 rupees. Okay, 30 rupees. Then here he present in different way. I explain you. 20 rupees into 1000 unit 20,000. 20 rupees 1200 24,000. 20 rupees 1600 32,000. 20 rupees into 2000 40,000. Direct wages same way. 30 into 1000, 30 into 1200, 30 into 1600, 30 into 2000. That amount is written in the column. Okay, then he divide that variable and he present in the first cases side by side variable fixed are given. Here he take all the variable cost in one side, all the fixed cost in other side. For example, selling expenses. Take the selling expenses. He leave the it is administration overhead is fixed cost. It is shown next. Selling expenses 50% fixed and remaining 50% variable. That is remaining 5 rupees variable, 5 rupees fixed. Take the 5 rupees. Selling expenses 5 rupees. 5 into 1000, 5 into 1200, 5 into 1600, 5 into 2000. He put it in the one column. In the first problem, it is shown there itself, variable and fixed. But here, the variable is taken separately, fixed is taken separately. And then distribution expenses, 20 rupees, 75% variable, 75%, that is a 15 rupees. 1000 into 15, 15,000, 1200 into 15, 18,000, 1600, 15, and then 15 into 2000. Okay, all the variables are brought to one pair. That is marginal cost. Okay, then fixed cost. Administration overhead. You see that administration overhead 20 rupees. Here 20 rupees per unit is given. It is very important. If per unit is given, you multiply with the number of units given at that capacity. For example, 1000 units is given. For 1000 units, 20 rupees is fixed cost. You multiply with that given quantity, 20 into 1000, 20,000 to arrive the total amount. If you take another amount, another units, it will give the different total amount. So you multiply with the given level of output, 1000 units into 20, 20,000 rupees. Then you put 20,000, 20,000, 20,000, 20,000. But at the same time, you see that the per unit cost will differ. 20 rupees, 16.67, that is 20,000 divided by 1,200, 20,000 divided by 1,500, 20,000 divided by 2,000. So the per unit will differ. Then selling expenses. Selling expenses 50% fixed. 50% is 5 rupees. 5 rupees fixed. 5 into 1000 units. You take this 5 into 1000 units. That is a 5 rupees. 5000 rupees. So you put 1000, 5000, 5000, 5000, 5000, 5000. Total is same, but different per unit 5 rupees, 4.17, 3.125, 2.15. Okay, then you go for the distribution expenses. 25% fixed. 25% fixed means 20 into 25, 5, again, I think 5 rupees. 5 rupees fixed. 5 into 1000 rupees. That is a 5000. Again, the selling and the distribution expense, 5000, 5000, 5000. Okay, but the per unit differ. Now you add all the total. All the total is added. So total in the first column 1 lakh rupees, second column 1 lakh 14,000, third column 1 lakh 42,000, for 2000 unit 1 lakh 70,000. Then sales is given 130 rupees. You see that first line sold at rupees 130 per unit. So you see that and the sales is given 130 into 1000 units 1,30,000, 130 into 1200 units 1,56,000, 130 into 1600 units I think 1600 units 2,08,000, 130 into 2000 units 2,60,000. The difference is profit. Here he is it show profit also for 5,000 sorry 1000 units 30,000 will be earned. The company earn 30,000. In case of 1,200 that 42,000 is earning, and 6,000 1,600 66,000 is earned, and then 90,000 then is meant for 2,000 units. You see that the number of units are going up and the profit percentage will also growing. Okay, that is depends on two things. One is number of units, another one is fixed cost. Okay, here in the flexible budget is differentiated from first one. All the variable are taken one side, all the fixed are taken another side, and it is compared with the sales and find the profit also. They can prepare in different way. Already I told you there is no rule of thumb in the case of format of the budgets. Okay, this depends on the people. Okay, so I think I crossed the time. Shall I explain this one or go to the next chapter? Okay. Any any doubt? Any doubt in the previous problem?
No, sir.
Okay. Shall I explain this problem or go to the next one? I take only the three important problems. That three are different. That's why I am taking. The first one is it is a combination of per unit and total amount. Second one is all are per unit item. The third one is see that all are total amount. Total amount is given in the problem. So okay, I explained this one. With this we close the budget. Okay, prepare a flexible budget for overhead on the basis of following data. Assign the overhead rate 50%, 60%, 70% capacity. Okay. Given capacity is 60%. So you have to prepare budget for 50% and budget for 70%. Okay. Indirect material, variable overhead. It is under the head variable overhead. You need not bother about the word indirect material, indirect labor, because it is comes under the category of variable overhead. Always indirect material, indirect labor are taken to factory overhead. The overhead may be both fixed and variable, but here it is given in the problem just like this. Indirect material, you take it direct material, direct labor. Okay, 6,000, 18,000. Semi-variable, electricity, 40% fixed, 60% variable, 30,000 is given. Repair, the same. These two are semi-variable. And then fixed overhead, depreciation, insurance, salary, everything, the total overhead is given. Estimated direct labor hour, the hour is given. Here number of units, instead of number of units, number of hours worked by the employee is given 1,86,000. Okay, now we are going to prepare a budget for 50% and 70% capacity. See this. Okay, capacity levels it is given. First variable overhead, indirect material. It is given. See that at 60% capacity, 6,000, 18,000 is indirect labor, indirect material. Okay, take this. You put the 6,000, 18,000 in the 60% capacity. No issue. And then for 50%, how to convert? 6,000 divided by 60%, 6,000 divided by 60 into 50, into 50. So 6,000 divided by 60, that is a 1,000. 1,000 into 50 by 550, sorry, 6,000 divided by 60. That means 600. 600 and then 100, 100 per percentage, 100 per percentage. You multiply with 50%, that is 5,000. 6,000 divided by 60 into 50. You calculate like this. If you have calculator, you do it now. And then 7,000, how do they arrive? 6,000 divided by 60 into 70%, into 70. Suppose number is given, number of units is given, you do the same. 6,000, for example, 600 units are given. For example, instead of 60%, 600 units are given, then you do like this. 6,000 divided by 600 into 500, into 500. 50% capacity 500, 70% capacity 700. You assume like this. 6,000 divided by 600 and into 500. So the same way you have to use that. You apply the same concept for if the units are given, if the capacities are given. You apply that. Same that. Indirect labor. Indirect labor 15,000. 15,000. 18,000 is given for 60% capacity. Take the given capacity. 18,000 divided by 60 into 50. It will come 15,000. 18,000 divided by 60 into 70%, it comes to 21,000. So you multiply like this. And then semi-variable overhead. Here he present in the same line. For example, electricity, fixed variable. In the previous problem, they take it differently. In this problem, this one is the correct. This one is correct. Fixed. Take this. Electricity 30,000. 40% fixed. 40% fixed means 12,000. Okay, 12,000. 12,000 fixed. That means 30,000 into 40%. 12,000. 60 into 30,000. 60 into 30,000, 18,000. 18,000 variable. Okay. You go to the 60% column. See that 60% column, 12,000 fixed, 12,000 fixed, 18,000 variable. They put like this. In the fixed amount, they take the same amount for 5,000 units, 50% capacity. They take the same amount to 70% capacity. Fixed is constant. And again, 18,000. 18,000 it is a variable. 18,000 divided by 60 into 50. Then it comes 15,000. 18,000 divided by 60 into 70, it comes to 21,000. You have to separate like this. So you divide into variable and fixed. Then variable is multiplied by capacity level or units level. Fixed must be shown constant amount shown in the books. Okay. Then repairs. You see that repairs 80% fixed. 3,000 into 80, 2,400. 2,400 is fixed. 20% variable. That means 3,000 into 20, 600. 600 is variable. You go to and see that and the 60% capacity. See that fixed 2,400 and variable 600. You must put that information in the 60% capacity. Then only you have to calculate for 50%, calculate the amount for 70%. So 2400 common to all, and 600 by 60 into 50. 600 by 60 into 70. So 700. That is gone. Take this, another fixed overhead. There are three fixed: depreciation, insurance, salary. 16,500, 4,500, 15,000. Fixed means it is fixed for all the categories. Same amount is written. 16,500, 16,500, 4,500, 4,500, 15,000, 15,000. Now you add all the nature. You are adding the first column 50% capacity, it comes 85,900. And 60% capacity 93,000. 70% capacity, it comes 1,100,000. Okay. Again, you go to the problem. See that the estimated direct labor hour 1,86,000. It is at the capacity level of 60%. You put it in the 60% level. See that the direct labor hour, as I did total cost, number of units. Instead of number of units, direct labor hour is given 1,86,000. It is mentioned in the 60% capacity. Then you have to calculate again 1,86,000 hour for 60%. 1,86,000 divided by 60 into 50, then it will come 1,55,000 hours. So at a 50% capacity, 1,55,000 hours will be used. And then next, for the 75% capacity, again 1,86,000 divided by 1,86,000 divided by 60 into 75. Into 75, it comes around 70%. It comes on around 2,17,000. Just like variable cost, you have to do it. Then now you have to cost per hour. Cost per hour is calculated. That is total cost divided by number of hours. 85,900 divided by 1,55,000. 1,55,000, it comes around 55 paise. And then 93,000 divided by 1,86,000, it comes around 50 paise. And then 1,100 divided by 2,17,000, 46 paise. So the overhead, that is a labor hour rate. Labor hour rate per hour is determined. Okay, I hope you understand. Is there any problem?
Yes, sir. Understand, sir.
Okay. Okay. I hope you understand.
Sir,
Then,
sir, previous question, I have a doubt.
okay, ma'am, you tell. Okay. Go to
Mate,
the, uh, ma'am, which what doubt, ma'am?
it's not clear. Okay. Selling expenses 5,000 and 4.17 how to get.
Okay, ma'am. Okay, very good. See, 3,000, take the first column. The selling expenses 50% of 10 rupees is 5 rupees. 5 into 1,000, 5,000. Okay. It is mentioned for all the levels. Okay. It is mentioned for all levels. Okay. Now, 5,000 divided by 1,000 units. 5,000 divided by 1,000 units, 5 rupees. The same 5,000 divided by 1,200. Next column. Divided by 1,200, it comes to 2 rupees 17 paise. Fifth column, 5,000
5,000
divided by
divided by
1,600. Okay, divided by number of units. Because you are calculating per unit. The column is per unit column. That means the total cost divided by number of units. So 5,000 divided by 1,600, 3 rupees 125. The same way, 5,000 divided by 2,000 units, it comes at 2 rupees 50 paise. So it will reduce. It reduce. See that I already explained. Once are asking the doubt. I explain. The fixed cost is remain constant for all levels. Illa level, all the level, the same amount. All the level, the same amount is given. Okay. But per unit will vary, will differ. Say, I give the quoted the example. If 5,000 rupees is given per hour, 20 students are joined. 20 students are joined. 1,000 divided by 20, 50 rupees. Per student pay 50 rupees. When 50 students are joined, 1,000 divided by 50, that is 20 rupees per student. When 100 students have joined, 1,000 divided by 100, 10 rupees. So that per unit cost will vary. Vary means differ from one unit to one level to another level.
Okay.
I hope you understand.
Okay.
Are you clear now?
Clear now.
You got it? Okay,
Got it.
okay. 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 Shall I move to next chapter? That is marginal costing. Okay. Marginal costing also same, taking the same concept as you are using for preparing flexible budget. Then I go for marginal costing. Okay, you see this. First, I start with the cost sheet item. You remember one time, once again, cost sheet. The cost of the product, cost means total expenses incurred to produce the product. The cost of the product have three components: material, labor, and expenses. The material is further divided into two categories: direct material, indirect material. Labor, direct labor, indirect labor. Expenses, direct expenses, indirect expenses. All the three are divided into further two categories. Direct material, direct labor, direct expenses are all always variable. That is, direct labor, direct expenses, direct material, all the three are called prime cost item. Indirect material, indirect labor, indirect expenses, all the three are collectively called as overhead. The overhead is further classified based on the function. If overhead incurred in the factory, it is called factory overhead. Overhead incurred in the administrative side, it is administrative overhead. The sales and the distribution in department overhead is called selling and distribution overhead. So it is divided according to the function. Then the factory overhead is further divided. Fixed factory overhead, variable factory overhead. For example, electricity. In the factory we are using electricity. When one machine is running, 500 units of electric power is consumed. Okay, 500 into 5 rupees, 2,500 rupees. When two machines runs, that is 1,000 units into 5,000 rupees. So electricity is a variable cost. So there may be a possibility of having variable cost in factory. And see the factory manager salary. Factory manager salary, whether the production is going on or not going on, he gets the same amount of salary. Whether one machine is there or 5 machines are there, his salary is same. So it is a fixed one. So in each area, that is a factory, whether it is factory, at my office, or sales, whatever it is, sales or distribution, wherever it is incurred, there may be two nature, fixed and variable. So in administration also, there are some expenditure fixed, some expenditure are variable. Sales, selling and distribution, some expenditure are fixed. For example, a depreciation of van, a delivery van, okay, fixed. Sales manager salary, fixed. That is commission to the salesman, that is variable. When 500 units are sold, he get 500 rupees. When say 1000 units sold, he get 1000 rupees. It is variable. So there may be chance for having fixed cost and variable cost. So in all the part, fixed cost and variable costs are existing. First you understand this. Then, so the total cost, now it is divided into fixed cost and variable cost. So based on the fixed cost and variable cost division, the marginal costing concept will be developed. Okay, why do they develop? Now we go to the marginal costing. So here we are not bothered about material, whether it is labor, whether it is expenses. We are not bothered about it. Whether the expenditure is fixed or variable. So the total cost of the product is divided into fixed cost and variable cost. For our convenient, it is classified, and variable cost are only considered because only there are some reason I tell you. Then you may see that the newspaper, you are happen to buy the newspaper. See 24 pages in the newspaper. One page, it is equivalent to 4 A4 size paper. One page, take one page, it is equivalent to 4 pages. When you, 4 A4 sheet is fixed on the one page of a newspaper, it will comfortably fit. So for one page, 4 A4 sheet is needed. For 24 pages, 24 into 4, 96 A4 sheets are needed. 96 A4 sheet, one A4 sheet is 4 rupees. Sorry, 50 paise. 50 paise, take 50 paise. 96 A4 sheet, 96 into 50, 43 rupees. So the paper alone comes 43 rupees. But the newspaper is printed, the messages are printed, it is circulated, printing is there, printing side there are so many employees, it is delivered to various parts of India or various parts of Tamil Nadu, sales, the distribution expenses are there. For all, taking all the expenditure, they just given it for 7 rupees or 5 rupees. Take 6 rupees constantly, 6 rupees. You see that, how is it possible? So 43 rupees is needed only for plain paper. But the printing is there, distribution is there, there are some more people are working for collecting information, and there are printing side, people are working. All these are going on, but they give the paper for 6 rupees. How is it possible? That is because of classification of expenses into fixed and variable. So the marginal costing helps to fix the minimum level of price. So how does it that? See again I explain you. Then 1000 rupees per hour. 10 students have joined in the classroom. Per head 1000 divided by 10, 100 rupees. Take another example. 100 students have joined. 100 students have joined. 1000 divided by 100, it comes around 10 rupees. 100 is reduced to 10. Take another example. 500 students have joined. 500 students have joined. 1000 divided by 500. Only 2 rupees. Take 10,000 students have joined. 1000 divided by 10,000. 1000 divided by 10,000. It is not possible, but for your clarification only I give it. 1000 divided by 10,000, it comes around 10 paise. 1 paise. It comes around 1 paise. See that. So 100 rupees per head is reduced to 1 paise, reduced to 1 paise. That is the nature. They have to some level of quantity totally absorb the fixed cost. Totally absorb the fixed cost. The fixed cost gets minimum, gets to even nil, even nil. Then only the variable cost is a part of the production cost. Is part of the production cost. So based on the variable cost only, they fix the prices. So that's why the costs are classified into fixed and variable. You can bring fixed cost to nil level or minimum ignoring level. You can bring, but variable cost you cannot bring ignoring level. It is variable according to the number. If you need 1 kilo, okay, 1 kilo is needed for 1 unit. 2 unit, 2 kilo is needed. You cannot reduce it. You can use alternative material, that is different. Low quality, high quality, that is different. But the amount of unit you cannot change. So variable cost cannot be changed. That's why the fixed cost, the cost is classified into fixed and variable. The management bring the fixed cost to minimum, ignoring level, and they consider only the variable cost as a production cost of the product. They fix the price accordingly. So now you can understand that what is marginal cost. The marginal cost means nothing but variable cost. Marginal cost means variable cost. So the marginal costing means the variable cost is considered for considering the fixing the price of the product. Price of the product. So the marginal cost nothing but variable cost. The variable cost includes direct material, direct labor, direct expenses, variable portion of fixed cost, the factory overhead, variable portion of office overhead, variable portion of selling and distribution overhead. All the items are included and collectively called it is marginal cost. So marginal cost means nothing but variable cost. Then the another one concept is the marginal cost. Suppose the fixed cost is absorbed by 10,000 units. You have some fixed amount. It is absorbed. Absorbed means recovered. Absorbed means recovered. Recovered at 20,000 units. If you are producing 20,001 units, 20,001 unit, the 1 unit cost is called marginal cost. The 1 unit cost that refers only variable cost. That refers only all the fixed costs absorbed by 20,000 units. 20,001 unit, the 1 unit starts to consume variable cost only. That is additional 1 unit cost is called variable cost. It is another. What is marginal costing? You see that marginal costing, the assignment of marginal cost, that is variable cost. You see that say this, and effect of the on profit, marginal cost and effect. Yeah, how does it affect the profit? By changing the volume, that is number of units, or by changing type of output, by changing type of output, by differentiating between fixed cost and variable cost. The expenses are classified into fixed and variable. Now you are increasing or decreasing the output or changing the output. How it affects the profit? How it affects the profit? That will be analyzed through the marginal costing. Through the marginal costing. So there are two work. One is determination of marginal cost. Another one is analyzing the effect of marginal cost on profit. It is marginal costing. Then there are so many characters, that is some assumptions are there. Okay, go to this level. Okay, see this. Already you have seen the cost sheet. Cost sheet. The cost sheet start with direct material, direct labor, direct expenses, prime cost. Add factory overhead, work cost. Add office overhead, cost of production. Add selling overhead, cost of sales, add profit, that is a sales. You have seen the cost sheet like this. So that cost sheet is prepared under absorption costing. What is absorption costing? Absorption costing includes both fixed and variable. Absorption costing includes fixed and variable in determination of cost of the product. But marginal costing, they take only production cost will be calculated based on variable cost only. They ignore fixed cost. Fixed cost is never considered as a part of product cost, because though it is sometimes you will see that there is no production, the factory is closed, though there are some expenditure out there, electricity is there, security is there, cleaning work is there, and everything. This is nature. Fixed is never stopped, never go with production. That's why. So all the absorption in absorption costing, fixed and variable are included, but marginal costing only variable. Here, the marginal cost statement, it is a cost sheet prepared under marginal costing. Cost sheet prepared under the marginal costing. So this is the cost sheet. It starts with sales. It starts with sales. Sales minus marginal cost. That is the variable cost, direct material, direct wages, direct expenses, variable overhead. He give collectively variable overhead, variable factory, variable administration. All these are included. Okay, see that. And then sales minus variable overhead, that equal to contribution. That equal to contribution. Contribution means gross profit. Contribution means gross profit. From the gross profit, it is deducted, fixed cost is deducted. So fixed cost, when you deduct a fixed cost, that it comes the profit. So the marginal cost statement, the cost sheet is like this. Sales, short form. You see that short form, sales minus variable cost equal to contribution. From contribution, you deduct fixed cost, that remaining amount is fixed profit. Okay, you understand this concept. Then, now I explain some inner values. Inner values, you see that sales minus variable cost equal to contribution. Okay, sales 100 rupees, variable cost 60 rupees. Now the contribution is 40 rupees. Okay, you want to know how much variable cost is not given. How to calculate the variable cost? Sales minus contribution, that equal to variable cost. Sales minus contribution. Sales 100, contribution 40, 100 minus 40, 60 rupees variable cost. The problem, in the problem, the variable sales price is not given. It's not given. So, okay, how to calculate it? Variable cost plus contribution, that equal to sales price. Variable cost 60, contribution 40. When you add both, sales price 100. It is a one segment. So you have to understand the format. This format is very, very useful. If you are clear, if you have clear that idea about the format, then you can solve all the problems without mistake. Then you see that. Then second part, contribution minus fixed cost equal to profit. So contribution 40 rupees, fixed cost 15 rupees. Okay, 25 rupees profit. If you want to know fixed cost, is not given. Contribution minus profit. Contribution 40, profit 25. So the fixed cost is 15. So you can calculate like this. And then you want to know contribution. Fixed cost 15 rupees, profit 25 rupees, add both things, fixed cost plus profit, that equal to contribution. 15 rupees plus 25 rupees, that equal to 40. So the two segments are there. Contribution, fixed cost, profit, one segment. Sales, variable cost, contribution, another segment. So understand this basic level. Then Next thing, this is the cost sheet. I hope you understand well. Anything, anything you need further information? Anyone? Shall I proceed?
Yes, sir. No need.
Okay, okay. Then there are the theoretical part. We leave it. Go to that
Sir,
another
please
thing.
tell
So,
your phone number.
ma'am.
Please tell your phone number.
Hello.
Sir,
Phone number.
please. Um,
Ma'am, phone number you need?
ah, your number.
Okay. ஓகே டெல் பர்சனலாக சொல்லட்டுங்களா இல்லை எனக்கு இட் இஸ் ஓப்பன் டு ஆல் 860 1500 860
Name.
860
Ah, 800 1500.
yes ma'am.
Sir, your name.
Okay.
Your name.
Mail ID
Your name.
ma'am.
Name.
Name
Your
name
name.
R okay R Punniyasheelan
Ah,
R Punniyasheelan PUNNIYA PUNNIYASEELAN
Punniya Season.
Punniyasheelan R Punniyasheelan.
Okay. Okay.
Okay ma'am. If I'm not taking your phone call, you send a message, so and so I want to contact, you please inform me, then I call you. Suppose sometimes I may be in a team call or some meeting, I'm not able to pick your call. Just you put a message, then I call you. Okay. Okay. Thank you. Next. Uh-huh. See this. Another concept I want to explain you. That's a cost, value, profit. Cost, total cost. Value, number of units. Profit, you know that earning. See this. Cost 10 rupees per unit. Number of units produced 1000 units. These 1000 units are sold for 12 rupees. So the profit is 2 rupees. The cost 10 rupees, value 1000 units, profit 2 rupees, because selling price is 12. You see that. How to maximize the profit? How to maximize the profit? It is a present situation. How to maximize the profit? I am reducing the cost 10 to 8, from 10 rupees to 8 rupees. The volume is same, 1000 units. Selling price 12. 12 minus 8, the profit is 4 rupees. 4 into 1000, 4000 rupees. Already I earned only 2000 rupees. Now I am earning 4000 rupees without make any changes in the value. Without make changes in the value, number of units. So, if possible, when you reduce the cost, then you will earn profit. It is another thing. Next, see that the selling price is 12. Now it is increased to 15. Increased to 15. The cost is same, 10 rupees. 15 minus 10, the profit percentage is 5 rupees. So the same units, 1000 units, 1000 into 5, 1000 into 5, 5000 rupees. Without making any changes in the production, I earned 5000 rupees. Earn profit more than that earlier earning. See this. So without making changes, we have to do. But you cannot increase the price. because competitors are there. When you increase the price, there are some competitors, they attract by showing the lesser amount of price. So the people, consumer go to competitor organization. So it is highly impossible. Then what is in our hand? What is in our hand? That is reducing the cost. So when you reduce the cost, you can earn the profit. How to reduce? So you have to change the material, you have to change the production process, you have to change the technology. So there are so many ways. There are so many ways are there. You have to reduce the cost of the product. Then these three things are interrelated: cost, value, profit. See that when the price is rising, the profit is increasing. Profit is plus point, that is a positive point. When the number of units increase, the cost also increase. Cost also increase. It is a negative side. Both are moving two directions. One is an anti-clock direction, another one is a clockwise direction. So these three should be trade off. Trade off means balanced with the help of some tools. So the cost must be reduced and the same time the profit must be maximized. That is the objective of all the organization. So you have to trade off, that is a well balanced these three things and you can maximize the profit. How can you maximize the profit? That is by using, there are four tools. One is profit value ratio, another one is break even point, third one is margin of safety, and fourth one is some indication, that is a profit for given nature. Then, so I explained the explain these four tools. Well, these are all explained already. You need not bother about. See this profit volume ratio. Profit volume ratio, that is a linkage between profit and the number of units. So number of units or you take the total sales value. Value means sales value. Profit and sales value. That is there is a link. There is a link between. If these two are show the high level, higher percentage, there is a possibility of maximizing the profit. If the profit volume ratio shows a low level, there is no possibility for earning higher profit. So that is the indication of profit volume ratio. So how to calculate it? The very simple. One thing you remember, marginal costing is based on formula. So formula is there. I give you nearly 4, 2, 4, 8, 10 formulas are there. You have to memorize, and with the help of formula, you can solve all the problem. Okay, profit volume ratio. How to calculate? PV ratio equal to contribution divided by sales into 100. So contribution, how to calculate? You are using marginal cost statement. Cost sheet, you have already seen that. Sales minus variable cost, that equal to contribution. Contribution divided by sales into 100. Then another thing, contribution, another formula. See that fixed cost plus profit divided by sales. You take the second part. When you want to know the contribution, profit plus fixed cost, that equal to contribution. Reverse concept. The same is given. Whatever it is, fixed cost plus profit equal to contribution. The same formula given in the different name. So, okay, first one formula, contribution divided by sales. Another formula, when two years are given, when 2 year sales are given, 2 year profits are given, at that time only you have to use this one, change in profit divided by change in sales into 100. This formula is applicable only when 2 year sales, 2 year profit is given. So at that time you are using change in profit divided by change in sales into 100. The profit is difference in profit is taken as a contribution. It is another one, second formula. Third formula, it is not given in the book. Third formula is not given. Okay. Third formula is not given. I give you fixed cost divided by break-even sales into 100. Fixed cost divided by break-even sales into 100. Break-even sales, later on I explain you. Fixed cost divided by break-even sales into 100. Okay. How does it will also working? It will also working. Three formula is necessary for calculation of profit volume ratio. One is contribution divided by sales into 100. Second one is change in profit divided by change in sales into 100. Third one is fixed cost divided by break-even sales into 100. Fixed cost divided by break-even sales into 100. Okay. These three formula is enough. This one is a composite PV ratio. When you are having 3 product, 4 product, then you have to calculate a PV ratio for combinedly. That is a total contribution divided by total sales into 100. For example, A product, B product, C product, D product. Before that, we have seen only one product. Here, 4 products are there. 4 product contribution are added, and it is given as a total contribution. 4 product sales are added, and it is given as a total sales into 100. That is called the composite PV ratio. Okay, that is another first tool in our hand is PV ratio. Another tool, that is a break-even point. Another one is a break-even point. Okay. Okay, break-even point. Break-even point means the total sales value is equal to total expenditure. Is equal to total expenditure you spent. That means there is no profit, there is no loss. So break-even point absorb all the fixed costs, absorb all the variable costs. So that is a sales that covers only fixed cost and variable cost total. There is the sales does not give anything to the towards the profit. That is the nature. So break-even point means the point or number of units or capacity level at which the revenue and the cost are equal. The revenue and the cost are equal. Income and expenditure are equal. And there is and the situation is there is no profit, there is no loss. It is called the break-even point. How do you calculate? Why do you calculate the break-even point? So when you calculate the break-even point, it absorbs all the cost. It absorbs all the cost. Then afterwards, any units produced, any units sold, that will give directly to the profit. Say for example, 5,000 units absorb all the cost. Then from 5,001 units onwards, you are earning. Now you have to decide how many units you are going to produce. 5,000 compulsory, because you have to meet the cost. After that, 6,000, 7,000, 8,000, whatever you produce, that will give profit. That for this purpose only, break-even point is to be calculated. So one formula is break-even point, BEP, fixed cost divided by PV ratio into 100. Here it is not given. Fixed cost. Why do I give 100? You see that fixed cost, for example, 5,000 divided by PV ratio 20%. 20%. How do you write 20%? 20 divided by 100. Then A divided by B divided by C. So in mathematical, A into C divided by B. So that's why fixed cost divided by PV ratio into 100. When you put like this, you will get the answer. So break-even point, that is the one formula. It gives the rupees, break-even point in rupees. You want to break-even point in units, break-even point in units, fixed cost divided by contribution per unit. You see that the next nature. Fixed cost divided by contribution per unit. Contribution per unit equal to break-even point in units. Break-even point in units. You apply both the formula. In the another things, you see that you can directly calculate. You can convert units into rupees. For example, break-even units into selling price. Break-even units into selling price. So selling price, you can get the break-even point in rupees. Suppose you calculated break-even point in rupees. Break-even point in rupees divided by selling price. Break-even point in rupees divided by selling price. Then you will get a break-even point in units. So you can utilize these two formula in different way. One is fixed cost divided by PV ratio into 100 in rupees, break-even point in rupees, break-even point in units, fixed cost divided by contribution per unit. Okay, these two formula help you to identify the break-even point. You see that already I told you PV ratio calculation. Fixed cost divided by, fixed cost divided by break-even sales into 100. Fixed cost divided by break-even point sales into 100. One formula is given. Say that at the break-even sales, there is no profit, there is no loss. That means the contribution is equal to fixed cost. Contribution is 40 rupees. Fixed cost is 40 rupees. No profit, no loss. So that means the fixed cost is equal to contribution. That's why we give that at a break-even level, the contribution is equal to fixed cost. That's why PV ratio is calculated by using the formula fixed cost divided by break-even sales into 100. Into 100. Okay, I explained you that another. It is a second tool. The third tool, second tool is how much units are compulsorily we produce to meet the expenses. It is a point. Then third tool is margin of safety. Margin of safety means the sales which give the profit. The sales which give the profit is margin of safety. So that means up to 5,000 units, all the expenses are absorbed. 5,001 to above units that are all contributing towards profit. So that 5,001 onwards, it is called margin of safety. Margin of safety. How do you calculate? How do you calculate? There are two formula. One formula, say that margin of safety. One formula, that is actual sales minus break-even sales. From the actual break-even sales, no loss, no profit. That sale is removed from the actual sales. Then the remaining sales give the profit. Another one formula, profit divided by PV ratio into 100. PV ratio into 100, then that is called margin of safety. Margin of safety percentage, how much sales contributing profit, that is margin of safety divided by actual sales into 100. So these three, all the three concepts, that is PV ratio, three formula, break-even point, four formula, margin of safety, two formula. So totally 9 formulas are very, very important. You have to memorize. Without this formula, you cannot solve the problem. Then another two things. Here I want to show the two application of PV ratio. One is I sold a certain amount of goods. So there is a particular sales, particular amount of sales. What is my profit? How much I earn from the sales? You want to know the sale, that is a profit for given sales. Profit for given sales. The sales is given. You are going to calculate how much profit the sales will give. That is the problem. That is a profit for given sales. The formula is profit equal to sales into PV ratio. Sales into PV ratio equal to contribution. Sales into PV ratio that rise contribution minus fixed cost. Minus fixed cost, that is contribution minus fixed cost. Automatically it will give the profit. You apply the given value, given sales value, take the sales value here and multiply by PV ratio. From this you deduct a fixed cost, then you will get a profit. It is profit for given sales. Another one concept, I want this amount of profit. How much sales I am going to do? That is another nature. That is sales for given profit. First one is profit for given sales. The second one is sales for given profit. So then you have to apply this fixed cost plus desired profit divided by PV ratio into 100. So certainly it will give the sales which give the expected profit. What you expected, that you have to go for that level of sales. Another, it is one other thing. Then you want to fix the selling price. Use this variable cost divided by 100 minus PV ratio, then it will give the selling price. Already 10 rupees are there. 10 rupees I want to reduce to 8 rupees. Now you have to how to reduce the variable cost portion, how much reduce, that will be calculated. So these are all the theoretical point of view of the marginal costing. Hope I understand the marginal cost. What is marginal cost? What is marginal costing? How it works? How it helps the manager to reduce the cost? These things are discussed in detail. And I show one problem. Only I think I am hearing. Okay. I show one problem now, and if you permit me, then we will go forward. See this. From the following information, find out the amount of profit earned during the year using marginal costing technique. Okay. Fixed cost 5 lakhs. Variable cost 10 rupees per unit. Unit information is given. Selling price 15 rupees. Output level 1,50,000 units. Now you can change it. You can use it whatever it is. Selling price, whether it is per unit, whether it is total cost, the format is same. Sales minus variable cost, that equal to contribution. Selling price 15 rupees. Selling price 15 rupees. So variable cost 10 rupees. Contribution 5 rupees. Contribution 5 rupees. Now you can calculate it, or it is shown that total amount because the units are given 1,50,000 units. The same result will give. See, sales 1,50,000 into 15, variable cost 1,50,000 into 10, contribution is given, fixed cost 5 lakhs is given, 2,50,000. The marginal cost statement is prepared. You need not prepare this statement. You can go directly and solve the problem. 15 rupees sales minus 10 rupees, 5 rupees contribution. Now the PV ratio is contribution divided by sales into 100. Contribution 5 rupees, sales 15 into 100. You see that 1 by 3, 33.33%. See the PV ratio. That is missed. Sorry, that page is skipped. Okay. Here, okay, correct. The other units are given. Just you prepare a marginal cost statement. It is given. It is asked marginal cost statement to prepare. So it is prepared. Light. Okay. Then see that here one fixed overhead 1,20,000, variable overhead 2 lakhs, direct wages it is also variable 1,50,000, direct material it is also variable 4,10,000, sales 10 lakhs. Now you have to calculate the break-even point PV ratio. Okay, sales 10 lakhs. You take the sales minus variable cost. Direct material, direct wages, direct variable overhead. All the three are added. Total 7,60,000. Contribution is 2,40,000. Up to this level is over. You want to show the full statement. You deduct 1,20,000 fixed overhead from the contribution. You will get 1,20,000 profit. Okay. First, what is asked? PV ratio and break-even point. PV ratio equal to contribution divided by sales into 100. Contribution 2,40,000, sales 10 lakhs into 100, 24%. Okay. break-even point, fixed cost divided by PV ratio. Fixed cost 1,20,000. It is given in the problem. See the first line, 1,20,000. PV ratio as you calculated 24%. 1,20,000 divided by 24 into 100. You put like this into 100. So 12 divided by 24, that equal to 2. 2 into 100, that is a 50. When you multiply 5 lakhs. At 5 lakhs sales, the cost and the income are equal. This is the way you have to prepare marginal costing. And then shall I? Okay. Right. I will the hour is over, the time up. Then I will explain you the remaining problem. Okay, there are I think 30 to 40 important problems I taken. So I will explain you in detail in the next class. Thank you for joining and your patient listening. Thank you. Any doubt, please? Is there any doubt? Please let me know. I can before I come with some clarification. Okay. So thank you very much. Thank you very much. It is time for next class. You join in the next class. Thank you very much. Okay.
Thank you, sir.
Okay. I am leaving the platform.
Good evening. So we'll start with the topic where we left yesterday. Commerce as an electronic trading system. What are the special features? That is, we have some investors, those who are trading. It can be extremely profitable profession also. This trading in electronic, trading through electronic. Here we have. I'll share you the PPT. Just a minute. Is not able to see, no? Just a minute. Give me some. Is it visible now?
Yes, ma'am. Right now visible, ma'am.
Okay. Thank you. So, New York Stock Exchange (NYSE). So this is an auction market. They use they are using the floor traders to make most of their trades. So the stock on this NYSE, each stock on this NYSE, they have specialists. That is, a person will be there who oversees and they facilitates all the trades for each and every stock, and sometimes for some special stocks also. Next is NASDAQ, National Association of Securities Dealers Automated Quotation System. So this NASDAQ this is not a physical entity. They are known for their fancy market site in Times Square, but they don't do a lot there. This is an OTC market, and they rely on market makers rather than the specialists to facilitate the trading and liquidity through stocks. The next is Internet Concepts and Technologies. Network of network or the internet. This is a group of two or more networks. They all are interconnected physically. Okay, you can communicate and you can share data with each other, and you'll be able to act together in a single network also. So machines on one network will be able to communicate with the machines on other network. You can send data, you can send files, and you can also send the informations and receive informations. So this internet is a network of computers and smaller network. This is which will enable the computers around the world to communicate with each other. That is, you can transfer any type of files or any type of documents. the source. Even small networks will be able to connect to the big network. So the internet all the time, and because of this internet, we are able to grow a lot, and internet also is growing a lot. Next is evolution of internet. So even though this e-commerce encompasses all forms of electronic commercial transactions, the recent commercialization of this internet is through electronic commerce. Okay, it is facilitated through the growth of electronic commerce. So today's internet basis was initially developed by US government, that is through US government. They invested in computer networking technology in 1960s itself. So the internet, they have evolved through a series of advancements in case of networking and also in computer technologies. So they had their beginning in 1969. The ARPANET, they provided a test bed, and also we are able to see other significant events which is included in the included the introduction of the desktop computers, and we are able to see the development of networking tools also, like FTP, Gopher, WW, and the release of graphical browsers also. So this is the history of computer. Just a bit. So from 1960s, we could see that they had their initial thing in the 1960s. System. In 1969, the Department of Defense Advancement Research Projects organization USA, no, they created an experimental network that is called ARPANET, Advanced Research Projects Agency Network. So in this, they are providing a test bed for emerging the network technologies. The next is the 1970s. In 1972, the National Center for Supercomputing Applications, that is NCSA, they developed the telnet application for even remote areas. Okay, they that is the people from remote areas also were able to log in. So it was easy for them to connect even to a remote computer. Then the FTP, file transfer protocol, it was introduced in 1973, so that they were able to standardize the transferring of files between the computer networks. 1980s, there were some important events occurred in 1983. TCP or IP, transfer TCP and IP, transfer control protocol. IP is internet protocol. They had some set of rules which describe how computers will communicate through a network, which is used on the ARPANET. So this decision is setting a standard for the other networks, and it is generating the term internet, because a network of networks which either uses the TCP or IP protocols, or they're able to interact with these TCP and IP networks. Actually, to keep the military and non-military network sites separate, this ARPANET splits it into two networks, ARPANET and MILNET. So the first desktop computers were started in 1982 to 83, and in that many were equipped with an operating system called Buckley Unix. So there was a networking software. So it made a easy connection to the internet using this telnet. And in 1987, the NSF awards, they grant to, that is the NSF, they grant to Merit Network in, to operate and manage future developments of this NSF and NET backbone. So this Merit network, they collaborates with the international business missions, that is IBM Corporation and MCI Telecommunication Corporation, so that they can make some research and develop more faster networking technologies. And in 1989, what happened? The backbone network was upgraded to T1, which means they are able to transmit the data at the speed of 1.5 billion bits of data per second, or about 50 pages of text per second. If you want to understand it very easily, you can say that 50 pages of text per second they were able to transmit. In that speed, they were able to transmit the data. In 1990s, in 1990s, the ARPANET dissolved in 1990, and Gopar developed at the University of Minnesota in 1991. And this Gopher provides a hierarchical menu-based method for providing and locating the information through the internet. And in 1993 to 94, the graphical web browsers, this Mosaic and Netscape Navigator were introduced, and that spread throughout the internet community. And because of their initiative nature and the graphical interface, these browsers make the www and the internet very much appealing to the public people. So through this internet, we are able to connect throughout the world. We are able to connect billions of users. About 1.1 billion people are using the internet today. So the internet is used for many things. We know for what are the purposes we use. Next is web technologies. Web servers and web browsers. They are helping us to communicate client-server computer programs. This will help us to distribute the documents, helping us to distribute the information. This is called web data. Okay. So this web data, it is marked up in the HTML language for presentation and interaction with people in through web browsers. And each and every web server, it is using an IP address or domain name, as well as they have port number for their identification. So we use web browsers for sending data requests to web servers with the help of HTTP protocol. And the web servers, which runs on server computers, they retrieve the requested data from local disk, or they generate the data and they mark up the data in HTML, and they send the result as HTML files back to the web browser. So some of the web server programs is popular are Apache, Tomcat, and IIS. And web browsers are like Firefox. These are very popular. Web architecture. So a typical web application, this involves 4 tiers. Um, so for rendering data presentation in HTML, a web server program also generates data presentation. We have an application server program which is computing the business logic, and we have a database server program which provides you the data persistency. Some basic functions of which web browser is doing. So they are interpreting the HTML markup and they are presenting the documents for us visually, and they support the hyperlinks in HTML documents. So when you click the hyperlink, it will lead to the corresponding HTML file, which will help us to download from the same or from the another web server, and just present it to us. Then the HTML form and the HTTP protocol is sending request and data to the web applications, and is helping us to download the HTML documents. It also helps to maintain cookies on client computers through the web applications. Again, it is sending back all the cookies to the website. Then, if you want to support extra functions, like if you want to play audio video files and running Java applets, then you have to use the plugin applications. Next is the global publishing concept. Global publishing concept, that is a large part of the growth of the World Wide Web, is attributed to their ability to integrate a variety of informations from the distributor servers. So in this integration process, the web addresses uh, several issues, and they also offer us some advantage. The advantages are, first one is platform transparency. So you can access the web through a piece of software. It is called as browser. Whether the browser is running on the Windows or X Windows, it is offering you the same interface. So the web is not limited to any single platform or for any single machine. The next is distribution transparency. So the web is distributed information system. So the information what is stored at a variety of this geographically dispersed server platforms is always available to the web users in a single interface window. So the nature of the web, the distributed nature of the web is enabling us to successfully provide more information. It has been stored in thousands of servers, which is located across the globe. The next thing is information type transparency. So the web is offering a seamless integration of multiple types of information content. It can be text, it can be graphics, sound, it can be videos, and then data in different formats can be integrated, and this is also displayed uniformly through the browser interface. So the concept of this hypertext, no, really means that instead of sticking to reading text in linear rigid structure, the important terms can be made rich, by just for that alone they can give link or more explanation can be given for that. The next one is interactive. The information which you browse on the web, it is based on how you select and click on the links. So when you click the link, it retrieves and offers you additional informations on this page. So a simple interaction on the web will lead you to more informations. So web servers will collect the input information from the user, and through they have a mechanism through that they collect, and they add it to the database. They update the database, and they give you the customized information based on the inputs given to it. Next is dynamic. The information which is retrieved by the browsers, it is stored in the sites, and they are offered through a web server. At any time the information is updated at the server site, the latest version of that will be available to the person who's browsing it also. So unlike like this published documents and books, where where you can see that every new version or edition will be distributed physically. So the web publishing does not incur any cost of reproducing the copies. Anyone who is accessing the publication, they can read the latest version on the browser, on their browser screen. Next is the hypertext publishing. And before that, I think graphical and navigational I have not completed. Yes, graphical and navigational. So the capability of the web is to integrate and display the graphics, uh, text, and other multimedia formats in color on a same page. So probably the reason for this is it gains popularity for a short span of time. Prior to the web, no, the information on the internet was accessible through the command and menu based interface only. So the hyperlinking mechanism has reduced this task of navigating the informations to point and click. The next is the hypertext publishing. So this is a system where the readers, they are able to follow hypertext links through a broad and growing body of published works. Here the hypertext publishing is involving more than the publication of isolated hypertext, like hypercard stacks. This hypertext publishing system is providing an open and relatively inexpensive medium. It is very much it is not expensive. Okay, they are you can make use of the links, that is electronic publication of reference links, indexes. All this helps to speed the transmission of ideas. And this criticism links will help us to filter the mechanism and will help us to make our evaluation in a can evaluate it in a very speed way. Then the benefits of hypertext. Hypertext is providing you a flexible working environment where the user can temporarily stop reading the current material and they can look into some other material, and you have some benefits. The first is ease of tracking references and creating a new one. So this is um, machine support for link tracing. The machine support for link tracing means all the references are equally easy for us to follow forward or backward. So in many hypertext environments, the user will be able to contribute their ideas, their works, and they're able to publish it into the website. So the user can produce their own networks, or they can simply annotate someone else's documents with a comment. That is, they need not without changing the reference document. They are commenting. They are sending the document using someone's documents. Next, ease of navigation. So the users are having faster access to the information. They're able to access it in a quick way. Navigation tools like bookmarks, history list, searching tools. These are all are helping us to use the. They're helping us to access quickly to any documents. And this bookmark is allowing to return to the points of interest, and the history list is helping us to track the learner's navigation steps. Next is the reader or learner control. So this hypertext environment is it is giving the learner control over parts of learning. That is, the reader control allows the learner to make choice in navigating and manipulating the content of the sites. That is, the learner, he can navigate or he can manipulate the content which is given in the site. As well as this hypertext is allowing for non-linear movement in a document. That is, they give an option like they can quickly return to the point of origin. Next is how you can analyze a problem through different kind of views. That is, through different links. How you can analyze a problem. What is a new way created? First thing is critical thinking. So this hypertext is encouraging the users to think more critical, because they're facing many views, from different people. For one topic, different people give different answers. So this web hypertext node is providing you more complete and complex and wide information. They have the power of linking. So the information you can see in the website when you ask for some particular topic, whatever related to that will be shown for you. From that we select and we make use of that. So from different sources you get the information, and it is engaged. That is, the users are making it critical thinking, as they make their own choice. They discover and they solve their own problem. They have their own route by studying the topic what is given. And now it is even more environment friendly. So you need not print, or the distribution cost, everything is reduced. So you need let us presenting the manuals and handbooks. We can reduce the paper, stamp, courier, and all related administration cost because of using this internet. Next is up to date and accurate information. So the writers of hypertext, they can easily assess their work, and they can update their information and links and references. Then they can store a large amount of information. So with hypertext, you can store a large amount of information in one media. So, for example, the websites you have more links. There are many links that one document connect to other documents, and we have to browse for that in the computer. Next, have the better visual prominence using animation or interactive graphics to make an interesting way of learning. So many websites know they have their animation or moving pictures um, because they want their website to be more interesting. The next is collaboration. So several authors they are able to collaborate with the comments about the document. Then information structuring. So both hierarchical and non-hierarchical organizations they are able to impose on this unstructured information. Even multiple hierarchies also they can organize the same material. Then global view. So browsers they are able to provide the table of content style what they are viewing, how the global and local views can be mixed effectively. Everything can be given in that. Next, the customized documents. So the text segments, it can be threaded together, like allowing the same document to serve for multiple functions. Next is modularity of information. Since we have the same text segment, it can be referenced from several places. The idea can be expressed with less overlap and duplication. Then consistency of information. So you can have references from different texts, and suppose if you move the text even to the other documents, the link information will still provide you direct access to the reference. So if that is when you do research, you can know this. This references when you give it in the text and below you give the link. If you click that link, it will automatically take you to the web, that portal, to that link, to that site where you get so and so information. Next is task stacking. So here the user is supported in having several parts of inquiry. It is active and they are displayed on the screen at the same time. Next is the client server concept. So all the e-commerce applications they follow this client server model. So the clients are device plus software. They request information from the servers. So the client server model of computing is common in the networking. So they have two computers, the client and the server. So the client is the one who is initiating the action, and he'll be having the control. The server is to provide a service which is uh, provide a service on demand. So the server is a very large computer that which can handle even several clients at one time. So this client server model is replacing the traditional mainframe based models which was working well for a very long time. So the client server model is allowing the client to interact with the server through a request reply sequence, and which is governed by a paradigm that is known as message passing. The server is managing the application tasks, it is handling storage and security, it is providing you scalability or ability. So it can also add more clients, it can serve more customers. So the server is managing a lot of application tasks, it is handling storage and security. Again, I think I told this point. And this commercial users, they have only recently began this downsizing their applications for running on client server networks, which is very trending in this electronic commerce. So you could see the picture of how the processing is distributed in multimedia client server model. Next is hypertext publishing. So here the web has become an umbrella for very wide range of concepts and technology, which differ markedly in purpose and scope. And they also include hypertext publishing concept. They include universal reader concept and the client server concept. So this hypertext publishing, it is promoting the idea of seamless information world. Okay, there all information, all online information, you can access and you can retrieve it. So in simple way, the hypertext publishing, it is a primary application of web interest in hypermedia. The next is URL, uniform resource locators. So here the documents which the browsers display is or hypertext. They contain pointers for the other documents also. So the browsers they deal with the pointers in a transparent way. So you have to select the pointer, and when you present it, the text to which it points. So here the pointer, no, it is implemented. They have a concept for it that is central to web browsers, uniform resource locators. So this URL, it is a digital library. Okay, it will have a unique call number which will provide you the exact location of every book in the world, including the country, city, library, and shelf location also will be included in it. So in practice, the URLs, no, it is the strings which is used as addresses of the objects of any document, of any image on the website. It is giving the address of that object. So you can think of that as an analogous for our email address. Just now our address is unique and it can be used by any other internet user for sending us through mail. So without knowing exactly where you are, the URL will mark the unique location on the internet where a file or service is found. Okay. So they have a consistent pattern. URL is following a consistent pattern. The first part is describing the type of resource. The second part is giving the name of server housing resource. Okay. The third one is giving the full file name of the resource. So all these URLs are universal and they provide access to a very wide range of network services, and it is required in separate applications in the past also. And for a new network protocol, you can easily form an address as the set of parameters are necessary to retrieve the object. So if these parameters are encoded into a concise string, they have a prefix. You can identify the protocol and you can encode. And you can see some of the world formats just being typed here. And you have URLs for internet news and news groups also, the NNTP protocol, and you have HTTP archives, delta destinations. Next is HTTP, Hypertext Transfer Protocol. So this is simple request response protocol, and this is run over TCP, and this is the basis of www, that is World Wide Web. This is a protocol for transferring the information. No, if you want to transfer your information efficiently between the client who is requesting and between the server. Okay, so the data transfer can be a plain text, it can be an hypertext image or anything else. So when a user browses the web objects, it is retrieved in rapid succession. Even often widely it is through dispersed servers. So you can retrieve documents through this HTTP, and this is an internet protocol, and this is it is similar in its you can read it is readable. Okay, and text-based style to the file transfer, that is FTP, and the network news NNTP protocols, which you use to transfer the files and news through the internet for many years. So suppose if you transfer an object over network, the information about them is transferred in HTTP header. So the set of headers is the extension of the multipurpose internet mail extension. So the client, usually the web browser, no, it is submitting a request to the web browser. So the server reads the protocol packet which is incoming, then it is processing it and it is sending the response. So the content type is built as part of the type of multimedia content, and that will be delivered again to the again as a response. So the content types which you use in the protocol are a subset of the standard MIME types. So it is stated by domain name like IP address at the specified port or standard port where you are. So if there is a proper connection, the browser it is submitting an HTTP request. So you can see the diagram, and this diagram is a HTTP session between the client and the server. What the process goes on between the browser and the web server which is providing the information. So these are the, in between there are some points, no? So these are the thing happening when a browser is giving request to the internet. So you have two phases. The first phase consists of the client's request submission, and the second phase consists of the server response. The client submission, again, it is depicted in three steps: opening a connection, sending the request, and the header information. So establishing TCP connection. So here the HTTP packets note is transmitted only after the client has established a connection with that server. So what happens in this step? The browser is just passing the URL so that you can identify the domain name also. And the services of domain names or DNS, no, it is helping you to resolve the name into an IP address. It's helping you to frame an IP address. Next is send request. So the browser is submitting the HTTP packets containing the request command, which is connected to the server, which is just being connected to the connected server. So the common HTTP request commands are get, post, head. Okay. So it is made up of three components: command method, the source identifier, and the protocol version number. Okay. Next is send request headers. So in this step, just a minute. Send request. Okay. So here send request headers. The next is send request headers. So here in this step, the browser is submitting the header information to the server. So the header information is the browser identity, its capability. It is how they are able to handle various types of content. And the header information is, they have a standard format of the header name and the value pair, and it is separated by the colon sign. It is colon symbol. Okay. Next is the server sends response to. So when you receive the client request and the header information, the server, it is processing the request and it is sending the response to the client. So as soon as the request is processed and is delivered, the server sends an OK response. So there will be some common errors also, like not found, internal server error, unauthorized access. You can see all these what I told now, no? Not found, internal server error, authorized access. All these we can see when we browse certain pages. So this response sent by the server, it is including the response code, and the protocol version also is included. That protocol version only is informing the client about the kind of syntax which is used in responses. The next is send response headers. So prior to the sending the required data, the server node is sending the information about the data, like what type of content, how much of length the content is, as well as what information is given about the server. So the response header they are sending it is sent by the servers. It is used at times where they are able to accomplish the authentication and they are able to set up the cookies. The response header information is also the same like syntax. Then sends request data. So here the server, after sending the last response information, they are sending a blank line to the black line, and that indicates the completion of the header portion of the response, and it is marking the beginning of the response data. The server is again sending the response data to the browser as the format which is indicated, the content type. Next, close TCP connection. Here the web server, they're completing the data transmission, and it is done with responding to the client request. Based on the client request, it is done. And in this stage, it is ordinarily close to the TCP connection. So an HTML document, they contain online images, they have embedded objects, and it is required for rendering it on the browser screen. So although the browsers can submit a request for retrieving all these objects by opening or by closing the connections, the network bandwidth and the server efficiency also can be improved when you keep the connection active for certain requests. It can be kept active. The next is HTTPD servers. So these are the servers which is used to publish the information through the www servers. It is called HTTPD servers. When you choose a web server flexibility, uh, administrating should be easy. Security features and familiarity and performance, everything should be considered. So you have to evaluate the task for for what purpose the web server is used, and the server used for this internet-based marketing and technical support task is more powerful server than the other web servers. So these HTTPD servers are ideal for companies which want to provide a lot of services from product information to technical support. For them, it is very much useful. Next is the HTTPD. So the information what is publishing is an important element in this electronic commerce organization, and they must know how to publish the information through this www servers, because that is called, sorry, www servers, this is called the HTTP servers. So you have to install and maintain a proper web server, which is not a very simple thing. It deals with a lot of security and administrative issues. Okay, so we are able to see now we have a lot of web servers to choose, and several servers are very much easy for us to install and very much easy for us to administer it. But the difficulties are not much initializing, and but choosing a server what the organization needs should be done properly. So we have a lot of issues to be considered in this, like what platform and operating system we can use, which is the right choice for us. And what kind of traffic loads are anticipated on the web server, whether it is heavy or it is light. So, what kind of security features you're envisioning, and how much flexible does a server should be? So, in the decision making process, compared to the other criterias like raw performance, the flexibility, the ease of administration, the security features, and familiarity are in the high order rank. And this is also very much important for us to evaluate the task for what purpose the web server is used. So the server, it is used for internet based marketing, and it is helping us technically. It is a new security features like encryption, that is also making it possible to consider that the web is a commercial transaction channel, and the web server, it has to support all the features. So this HTTPD, no, it is very much perfect for the companies, those who want to provide a multitude of services. That is, those who want to offer product information, right from product information to technical support. For them, HTTPD servers are very much useful. The other way of providing services are like through HTML pages and CGI scripts. So the web servers will be acting as a gateway to the other internet servers, like for Oracle, Gopher, and News. Next is HTML, hypertext markup language. So this is used for writing web documents, which is interpreted and rendered by web browsers. So in the early 80s, IBM has developed the concept of describing the documents by their elements. So each document has similar elements, like they have title, they have address, they have headings, they have body text, they have sections, and they have paragraphs. This HTML, no, it is a document formatting language where the formatting instructions, it is called as tags. So in HTML, tags means words and symbols which is enclosed within less than symbol and greater than symbols. So the each tag in HTML, they have a matching end of the tag markup. So for a particular markup code, the matching end of the tag markup code will be denoted. So this HTML document is a plain text document. They contain some markup codes. I think you can see the tags which is also associated with like so these tags are denoted in the documents. This HTML head body with they have tag markups. So any plain text editor is enough for creating HTML documents. So the documents they are composed of several different elements like heading, title, paragraphs, lists. Okay. So in HTML structured documents, it consists of the head and the body portion. In simple documents, the header portion contains the identity information of the document, like you can see the title, the author, and similar information. And in the body portion, it describes the structure of the overall document. And they have some attributes like background color, image of the browser window, like so those things also will be seen. This is about the HTML text formatting tags. So this text character, it can be emphasized and it can be made to appear bold and underlined. however, which is required in a document. So, character formatting tags, it is two types. Character formatting tags is of two types. First type of tags is which is defining the logical formatting style. So logical tags are it is interpreted and it is rendered by the specified default behavior of the browser. So if needed, the users can also define these tags. It will offer flexibility when you view a document. So the physical style is consistent, no matter how the browser or whoever the user is accessing the document. So these are some of the tags which is used. Next is the CGI gateway service, Common Gateway Interface. So this is a specification where you can transfer the information from an information server and the World Wide Web server, okay, and another application. So the CGE program, it is designed to accept and return data which is which conforms to the CGE specification. So the program can be written in any programming languages. It can be C, Perl, Java, or Visual Basic. So CGI is they're using CGI to wherever the web server wants to send or receive data from another application, like from another database. They can use the CGI program. So if they want to interact dynamically, they use the CGA program. So what are some of the various steps in the CGI process? Some various steps are like, first step is, if an HTML form is filled out, the client browser it is assembling the query and it is forwarding it into the designated server. They do this using the HTTP protocol. So if you want to carry out this action, the forms begin with the construct. This form method equal to post action. So the action, it should be just pointing to the script and which will help you to process the data through that form. Step 2, the server is passing the data to an program which is to be executed. So the server is activating the scripts and it is passing the script. It uses the various values filled out by the user in the HTML form. They are doing it, and on a Unix HTTPD server, the CGI program will receive the form data. Okay. In step 3, the script is processing the incoming query. So the task is they have to return. Its task is to return an answer in the form of a document. So the document form they have to give, and the server again can pass back to the client browser. So they receive it in the document form, and it is producing it as a document for the client browser. And the document should be in HTML or text, but the other types are also allowed. Not only HTML text, but other types are also are allowed. So if you want to differentiate between the various documents type, the script must specify the type of the document. Next, step 4. So here the server is taking the document from the script and it is sending the package back to the client browser. And this is done through the HTTP protocol. And whatever the output it is generated by the CGI program is again sent to HTTP PD. Again, that will send back the output to the browser. So this is about forms and CGI. So in addition to the formatting linking tags, this HTML, they have tags to define or screen forms, and this is used for receiving the inputs from users. And you can process it within by using an application program. You can process it on the server side. at the server's end. So here the CGI features of HTML, it is enabling the web to be viable medium for commerce, for searching information, and for assessing and other interactive applications. So we have some attributes, three important attributes, which is guiding the action of the browser. Okay, so the form tag is having three important attributes, and that is guiding the action of the browser. Those attributes are, the first one is action. So this action attribute, it is specifying the CGI program or the CGI script, which is used for processing the data which is entered through the form. So the action field, it is accepting the role of the CGI program. Next is the end type. So here this attribute is specifying how the values are entered the form, or how it is encoded to transmit to the earl. So you have some valid formats or applications. And the last one is method. So this attribute, it is describing the method, like how to send the data to the web server. So how you can send the data to the web server, what method can be, through what method can be sent. So the two supported methods are get and post. So the browser is using the get or post protocol packet for sending the data to the server. So these are the first unit is over. Shall I move on to the? We'll just start. No, we will just start the second unit, and rest will continue in the. Just I'll give an introduction. So almost this time. So we'll just give the introduction for the second unit, and later we'll see the rest of that in the next class. Can we? Can you answer me? Shall I just give some introduction on the second unit? Second unit is about business models of e-commerce. So here the e-commerce is defined as any form of business transaction where the parties, they are interacting electronically. So the e-business, they are offering some personalized service, and they're also giving high quality customer service, and they improve the supply chain management. So here the goal of this electronic business is they want to generate revenue and they want to make profit, and this is similar to the traditional businesses. And the fact is that the internet has improved their productivity for almost all kind of business organization, what they're using. So the ultimate aim of this organization is they want to produce, they have to give productivity, and it must be and that productivity must be converted into profitability. So if you want to achieve the profitability as the final goal, you have to follow different e-business or e-commerce site position sites. Okay, which are being positioned themselves in different parts of the value chain. So if you want to generate revenue, um, e-business either sells products or services, or they also shorten the link between the supplier and the consumer. So many business to business electronic commerce models, no, they are trying to eliminate the intermediaries for delivering the products or services. They want to directly they directly go to the end users. So because they're cutting the middlemen, the company, they're able to offer cheaper products and better customer service to their customers. So what the end result is, the company, they are able to attain competitive advantage. They are able to increase their market share. They are able to increase their customer loyalty. So through this e-business, and the products are sold, it could be either through traditional products like books and clothing, or digital products like songs, computer softwares, or electronic books. It can be anything. Okay, shall I stop? Let us see that. Continue to the next class. If you want to ask anything, you can ask. If you have any doubts, you can ask. Yes, if I get response from you, then we can leave the class. Okay, shall we wind up? Okay, thank you. Yes, thank you, Shira. Thank you, Sita. Thank you. We'll meet in the next class.